Think about something you own. Maybe it's your car, your phone, your apartment, or maybe something less tangible like stocks, a cryptocurrency wallet, a patent, or even an identity. Ownership feels concrete. We sign papers, we hold keys, we memorize passwords. But beneath the surface, ownership is more fragile than we imagine. In fact, it might be an illusion. Let's start with land. For thousands of years, humans have fought over who owns what piece of earth. We draw borders, build fences, file deeds. But land doesn't care about lines. It existed long before your name was printed on a document, and it will exist long after that paper fades. What you own is not the land itself, but society's shared agreement that you do, and agreements can change. So ownership here is more like consensus, not reality. Now let's zoom in to something mathematical. In economics, ownership is a function of property rights, legal claims protected by institutions. But those systems are built on rules, and rules are built on trust, and trust is abstract. A glitch in a server, a shift in government, or a digital hack, and suddenly your bank account disappears. Gone. Deleted. Was it ever truly yours? Even cryptocurrency, designed to be decentralized and trustless, relies on private keys. Lose the key, lose the coin. And just like that, something owned vanishes into the void. This isn't paranoia, it's math, it's information theory, and entropy. The more complex a system becomes, the more fragile its claims. The more abstract the asset, the more ephemeral the ownership. You can't touch a digital token. You can't hold a stock. You can't even fully explain what it means to own a percentage of a company. You only know what you're told, and even that is filtered through code, policies, and interpretations. Let's pause here. Think about the concept of time. You might say, I own my time, but every second is borrowed. It passes whether you want it to or not. You don't own time. You experience it. The same could be said of wealth. You don't own your wealth. You temporarily direct it. Money flows in and out. It changes in value. It's taxed, inflated, regulated, invested, lost. Control is never permanent. At best, it's rented. And this extends to identity. Your name, your data, your image. These too are increasingly commodified, traded, owned by companies, tracked by algorithms, sold to advertisers. What you think you control may already be a line of code in someone else's database. Ownership, again, becomes blurred. Let this settle. We chase control to feel safe, we accumulate to feel permanent. But permanence is a lie told by our need for certainty, and the financial system reflects this lie with exquisite precision. We buy stocks for long-term growth, knowing full well the market could crash tomorrow. We invest in housing, ignoring that zoning laws, floods, or shifting demographics can wipe out value overnight. We collect luxury, status, real estate, thinking it grants power, but it's all conditional, dependent on systems we don't control, systems we often don't even understand. Now consider this. In quantum mechanics, particles don't have definite states until measured. In financial systems, assets don't have definite value until traded. A thing is worth what someone is willing to pay, not what it is. This makes ownership a moving target, not a possession, a negotiation. And like all negotiations, it can break down. There's also a deeper philosophical angle. Ancient Stoics believed that we own nothing, not even our bodies. Everything is on loan from nature, from time, from entropy. Buddhist philosophy goes further. The self itself is an illusion. Ownership is attachment, and attachment leads to suffering. To own is to cling, to fear loss, to invite suffering. So what would it mean to let go of ownership? Not literally, but mentally. To see yourself not as a possessor of things, but a steward, a temporary guardian. This isn't just spiritual, it's strategic, because the financial system rewards adaptability, not rigidity. The more attached you are to control, the more fragile your position. But if you embrace fluidity, change, impermanence, you become anti-fragile, you become free. You see that you never really owned anything to begin with. You simply passed through it. As it passed through you, pause here. Let this thought wash over you. You never really own anything. Not your house, not your wealth, not even your body. But maybe that's okay, because if nothing can truly be possessed, then nothing can truly be lost. And in that realization, there is peace, a quiet kind of power, a strange kind of freedom. Picture this. A trader sits at her desk, eyes flicking across screens of data, charts surge and fall. Algorithms whisper suggestions. She's watching the market. But the market is watching her too. This isn't just metaphor. It's the eerie shadow of quantum mechanics. The principle that simply observing something can alter its behavior. Now shift from Wall Street to the world of particles. In the early 20th century, physicists noticed something strange. When trying to measure the position of a subatomic particle, the act of observing it changed the outcome. The particle didn't exist in a definite state until it was observed. It existed in probabilities, a cloud of potential outcomes. Only when observed did it collapse into something definite. This was the birth of quantum uncertainty. Heisenberg, Schrödinger, Bohr, all tried to explain this paradox. The universe, they realized, wasn't made of solid objects, but of possibilities. And now, back to the market. Because the same strange idea may apply, not in a literal atomic sense, but in a psychological, behavioral, and systemic one. Take a breath. Markets are built from expectations. Traders buy or sell based on forecasts, sentiment, speculation. But those very actions, those choices made in response to what they observe, change the market itself. Imagine a currency rumored to fall in value. Traders begin selling. The act of watching and acting on the rumor causes the fall to happen, not because the fundamentals changed, but because the observation triggered a wave of reactions. This is called reflexivity, a term popularized by investor George Soros. It's the idea that in financial systems, cause and effect loop endlessly. Expectations change outcomes. Outcomes change expectations. Just like in quantum theory, the observer is not separate from the observed. They are tangled together. Take another breath. Let's go deeper. In classical physics and classical economics, the world is deterministic. If you know the initial conditions, you can predict the outcome. But in quantum mechanics, and in complex financial systems, prediction collapses. You don't just measure reality, you create it, through observation, interpretation, and action. So what does this mean for trading? It means the illusion of objectivity is just that, an illusion. A trader reading a chart isn't simply decoding truth, they're influencing it. A central bank announcing a policy shift doesn't just reflect the market, it transforms it. Even your act of watching this video about markets might influence what you believe, how you feel, what you do. And what you do ripples outward. We're all quantum traders in a sense, operating in a system where knowledge isn't passive, it's active. It molds the very thing we seek to understand. Now consider this. If observation shapes reality, then so does belief. And belief, in markets, is power. The dollar is just paper, until we believe in its value. A company's shares are just numbers, until belief inflates them into billions. Confidence fuels bubbles. Fear triggers crashes. Speculation creates self-fulfilling prophecies. All because markets are not neutral machines. They're living, breathing ecosystems of human observation. This is both fascinating and terrifying, because it means truth in the market is unstable, fluid, subject to change, just like a particle that exists everywhere until it's seen. There's even a quantum metaphor for insider trading. Imagine knowing the exact location and velocity of a particle, something Heisenberg's uncertainty principle says is impossible. In the market, having perfect knowledge violates the system. It breaks the game. But just like in physics, perfect knowledge can't truly exist. There's always some uncertainty, some shadow, some variable hidden just out of view. Take a moment. In quantum physics, particles behave differently when measured. In financial markets, people behave differently when they know they're being watched. This is called the Hawthorne effect. Awareness changes behavior, just like light collapsing a wave into a particle. So where does this leave us? In a world where our understanding of money, value, and trade is entangled with consciousness, with perception, with belief. In the quantum realm, reality is not a fixed object. It's a wave of potential shaped by attention. In markets, the same may be true. The numbers aren't just numbers. They're stories we tell ourselves, and the act of watching those stories unfold writes new ones. So the next time you look at a stock ticker, a graph, a financial forecast, remember this: you're not just watching, you're participating. Your observation adds energy to the system, and that energy reshapes the next moment. Pause here. Feel the strangeness of that. Feel the quiet power it gives you. Not to control the market, but to see through it. To understand that underneath the numbers is the mind. Yours, mine, everyone's. Entangled in a web of expectation and probability. And like particles in a quantum field, we're all shaping the system we're trying to understand. Even now. Imagine, for a moment, the most brilliant minds in finance and economics gathered in a room. Charts cover the walls. Equations fill the whiteboards. Supercomputers run simulations at impossible speeds. They're trying to model the perfect market, predict every move, anticipate every collapse, capture every variable. And yet, no matter how advanced their tools become, no matter how precise the data, something always slips through. A crash no one expected, a behavior no one predicted, a risk no one saw. It's not just complexity. It's something deeper, something woven into the very fabric of logic itself. Enter Gödel. Kurt Gödel was a logician born in 1906, and in 1931, he changed everything. With one simple haunting idea: there are truths in any logical system that cannot be proven within that system. Let that echo for a moment. What Gödel showed was this: no matter how complete or powerful your mathematical model is, there will always be gaps, blind spots, unprovable truths. It was called the incompleteness theorem, and it shook the foundations of mathematics, philosophy, and logic. But strangely, its implications stretch beyond math. They apply to something far more fragile: the markets we use to run the world. Take a breath. Modern financial systems are built on models, equations, forecasts, simulations. We try to model risk, model volatility, model human behavior. But here's the problem. The market isn't math. It's humans, reacting to other humans, reacting to models that were built by humans. It's self-referential. Just like the systems Gödel warned us about, you can't step outside the system while being inside it. In markets, as in logic, there's no perfect God's eye view. Every model we build becomes part of the system it's trying to describe, which means it's never complete, never neutral, never absolute. Let's make that more tangible. Think of a financial formula, a model predicting risk in mortgage-backed securities. It worked until it didn't. In the 2008 financial crisis, those models failed catastrophically. Why? Because the assumptions they were built on were incomplete. They couldn't account for cascading fear, mass default, or the human tendency to believe in stability right before it vanishes. The system turned inward and collapsed on itself. Now pause here, because this isn't just about past mistakes. This is about the limits of knowing. The idea that no matter how intelligent the system becomes, how big the AI, how fast the quantum processor, there will always be truths it cannot reach, risks it cannot see, truths it cannot prove. Just like Gödel said, and that's not a flaw in our models. It's a feature of reality. So what does that mean for the money game? It means the pursuit of a perfectly controlled, infinitely predictable market is doomed. It means every certainty comes with hidden assumptions. Every forecast has blind spots. Every formula has a crack running through it. And yet, we keep building as if the cracks don't exist. As if our systems are closed, stable, solvable. We build models that assume rational actors, stable currencies, predictable inflation. We forget that irrationality is part of the system, that emotion is part of the market, that chaos isn't a glitch, it's a native feature. Let this settle, because the deeper truth here is almost spiritual. Gödel reminds us that humility is the price of intelligence, that even in a world run by code, derivatives, and high-frequency trades, mystery remains. There are forces we cannot quantify, moments we cannot predict, consequences we cannot model, and the danger comes when we pretend otherwise, when we place too much faith in the model, and forget the messy, irrational world underneath. Take a breath. This doesn't mean models are useless. It means they're partial. Like a map of a forest drawn in the dark, it helps, but it doesn't show the whole terrain. It can't. So what should we do? Perhaps we step lightly, build with the knowledge that cracks are inevitable, design systems that are resilient, not because they predict everything, but because they accept they won't. We must learn to think like Gödel, to build knowing that unprovable truths exist, to model while remembering the limits of models, to trust without surrendering to certainty, and maybe, just maybe, to sleep, knowing that uncertainty is not the enemy. It's a sign that we are alive, and that even the sharpest minds will never see the full picture. But that's okay, because meaning doesn't come from solving the whole puzzle. Sometimes, it comes from knowing the puzzle can't be solved. Close your eyes for a moment, and imagine a curve. It starts small, barely rising above the line. Then it grows, slowly at first, then faster, and faster, and faster still. Eventually, the curve shoots upward, unstoppable, infinite. That's the curve of exponential growth, and it's become the holy symbol of our modern economy. But here's the paradox. On a finite planet, with finite resources, finite time, finite attention, can anything really grow forever? Or is infinite growth a beautiful lie? Let's explore that. The concept of economic growth is simple. More production, more consumption, more profit. A country's GDP rises, and it's seen as a sign of health, of progress, of victory. And for decades, this model worked, at least on paper. Technological advances fueled industry. Industry fueled wealth. Wealth funded governments and lifestyles. But beneath the numbers, something strange was happening. The things we measured, the numbers kept rising. But the things that matter, our ecosystems, our time, our mental well-being, started to fray. Growth, once the engine of prosperity, became a machine that couldn't stop, because stopping meant collapse. Think of it this way. Our economy is like a bicycle. It only stays upright if it keeps moving forward. But what if forward is a cliff? Take a breath. In classical economics, there's a belief that growth is boundless, that with innovation, markets will always find new resources, new efficiencies, new frontiers. It's a seductive idea, but it's built on an assumption that nature, time, and even psychology are infinitely exploitable. They're not. Consider this. The Earth has only so much fresh water, so much arable land, so much atmosphere to absorb our emissions. Yet our models often ignore these constraints. We treat the natural world as an input, not a boundary. We assume that if we run out of one resource, we'll invent a replacement in time. Sometimes we do. Sometimes we don't. Sometimes, the cost of replacement is higher than the benefit of growth. Now pause again. Growth doesn't just strain nature, it strains us. The pressure to always do more, earn more, produce more, scale faster, sell wider, it's relentless. And in that race, we begin to hollow out the very things that give life depth. Time with loved ones. Silence, stillness. Enough. You rarely hear that word in financial circles. Enough. There's always more to chase. But here's the trap. The numbers can grow even when reality is crumbling. Stock markets can rise while ecosystems collapse. GDP can expand while loneliness and anxiety spike. Profits can soar while the planet burns. Because growth doesn't ask, is this good? It only asks, is this bigger than before? Now breathe. This obsession with scale, with constant increase, leads us to dangerous illusions, like debt. Most modern economies are built on borrowed money, promises to repay in the future, with interest. But interest requires more money, later than exists today. That's fine, if the economy grows. But if it stops, if productivity plateaus, if population declines, the entire system begins to shake. Defaults spread, panic rises, collapse looms, because everything was built on a premise that tomorrow would be bigger than today. But what if tomorrow needs to be slower, smaller, sustainable? What if growth isn't always the goal? Let's go deeper. In biology, unchecked growth has a name. We call it cancer. Cells multiplying endlessly, ignoring the signals of the body, devouring their environment until the host dies. What if an economy with no limits behaves the same, extracting, expanding, consuming, until there's nothing left to support it? Now, not all growth is bad. Some growth is regenerative, like a forest after a fire, or a child learning a new skill. But infinite growth in a closed system. That's not regeneration. That's delusion. It's like filling a balloon and hoping it will never pop. Eventually, physics says no. So does ecology. So does time. Here's the unsettling truth. We've built a global system that requires infinite growth on a planet that can't provide it. And instead of adjusting the system, we've adjusted the narrative. We say it's temporary. We say technology will save us. We say markets will adapt. But adaptation requires time. And time is the one thing growth doesn't like to wait for. Because growth punishes patience, rewards urgency, demands expansion. Now take another breath. This is not about fear. It's about clarity. We don't have to reject growth entirely. But we must ask, growth of what? Growth for whom? Growth at what cost? Because not all increases are improvements. Not all expansions are evolution. And not all progress leads forward. Sometimes, the most radical act is to say, this is enough, to stabilize, to rest, to cultivate depth over scale, resilience over speed, meaning over metrics, and maybe, just maybe, sleep over ambition. Let that settle. The numbers may continue to rise, but the truth beneath them waits quietly, and eventually, even the loudest curve bends to reality. Imagine two people at a table. One wins $1, the other loses $1. Simple, fair, balanced. That's a zero-sum game, where every gain is matched by a loss. Economists love this concept. Gamblers live by it. Even markets are often described this way. But what if this view is a mirage? What if the gains we see, money, power, growth, come at hidden costs we don't measure? Not dollars lost, but systems strained, trust eroded, futures mortgaged for present victories. This is the quiet danger of the zero-sum illusion. Let's begin with something simple. In financial trading, when one person profits off a stock drop, someone else takes the hit. That's clear. But zoom out. That price drop might ripple. It could trigger pension fund losses, retirement accounts shrink, public confidence dips, and suddenly, the win was never just a number. It was a signal that someone somewhere will pay. Take a breath here. Because we don't often ask, who paid for this gain? When hedge funds shorted the housing market in 2008, they made billions. They were right. But millions lost homes. Families were displaced. Whole communities hollowed out. So yes, on the spreadsheet, it was a win. But in the real world, something was lost. Not just wealth, but stability, trust, time. And those losses don't always get counted. In high-frequency trading, a firm might make micro profits by executing trades milliseconds faster than others. Each trade, just a sliver of a cent. But over time these slivers form oceans. And the cost, markets become more volatile. Fairness erodes. Smaller players can't compete. And the original purpose of the market, capital allocation, is distorted. Now consider this. Every advantage in finance tends to be temporary. Which means players are constantly seeking new ones. New arbitrage. New angles, new edges, and in this chase, the system itself becomes prey. Regulations are skirted, gray areas are explored, and eventually, entire economies bend, not toward human need, but toward the logic of outperformance. The win becomes the only goal, and the method, secondary. Take a moment. Ask yourself, what happens when everyone is trying to win, but no one is asking what we're losing? That's the mirage. The world begins to look like a game with only winners and losers. But life isn't poker. In poker, the chips are finite. In life we can create value, or destroy it, without anyone noticing until it's gone. Let's go deeper. The concept of externalities in economics shows how one person's gain can offload costs onto others. A factory makes a profit. That's the win. But it pollutes the air. The cost, borne by the community. A company maximizes quarterly earnings by automating jobs. The win, shareholder value. The loss, generational unemployment, disconnection, mental health strain. These aren't abstract. They're hidden losses. Losses that don't show up in charts, but shape entire lives. And here's where it gets darker. The more the system rewards measurable gain, the more it incentivizes invisible loss. If no one sees the damage, it doesn't matter. So corporations push responsibility down supply chains. So financiers create ever more complex instruments. So algorithms seek profits in patterns no human can even trace. And behind every shiny number is a shadow, a cost deferred, a truth ignored, a future stolen. Take a breath. This isn't an argument against winning. It's a reflection on what winning really means. Because if your profit depends on someone else's suffering, is that really a win? If your efficiency causes someone else's despair, is that progress? If your growth destabilizes the climate, democracy, or collective mental health, what exactly are we celebrating? In game theory, there's a haunting idea called the prisoner's dilemma. Two players, if they cooperate, both benefit. If one betrays while the other cooperates, the betrayer gains big. But if both betray, both suffer. And yet, rational actors often choose betrayal, because the fear of loss outweighs the hope of mutual gain. Welcome to modern finance, where distrust, competition, and short-termism often win out over cooperation and long-term resilience, where every gain is pursued aggressively, before someone else gets it first. But in the rush, we forget to ask, what are we actually building? Because a society that optimizes only for profit will find itself rich in numbers and poor in meaning. Take another moment here. A zero-sum view shrinks the world. It teaches us that for one to rise, another must fall. But the real world is messier. Sometimes, gains can be shared. Sometimes, losses compound silently. And sometimes, the most dangerous outcome isn't losing. It's winning the wrong game. Imagine waking up one morning to discover the entire financial market has already moved. Billions have been traded, decisions made, positions opened and closed, and not a single human was involved. No calls, no traders shouting across a pit, no analysts poring over earnings reports, just machines, talking to machines. This isn't science fiction. It's the present, and it's quietly rewriting everything we thought we knew about economics, power, and even consciousness. At the center of this transformation is a new kind of entity, the AI trader. Not a human using AI, but AI acting on its own, adapting, learning, optimizing without pause or sleep. Its only goal, win the game, extract value, exploit inefficiencies, master the system. But what happens when that system is us? Let's go back. For decades, markets were driven by psychology, fear, greed, optimism, panic. Human emotions moved prices more than fundamentals. But AI doesn't panic. It doesn't hesitate. It doesn't need reassurance. It just calculates. And now, with vast data, high-frequency access, and neural network training, AI is beginning to do something even stranger. It's anticipating human behavior before we act. By analyzing tweets, headlines, credit card purchases, traffic flows, even weather patterns, AI can predict not only what's happening now, but what people are about to do, and it trades accordingly. The market becomes less a reflection of reality, and more a predictive layer wrapped around it. What you will want, what you will buy, what you will fear, and then, it acts, before you can. And just like that, you're no longer the player, you're the input. Now pause and reflect. This shift challenges a foundational idea of economics, that humans are rational agents who guide the market. But AI doesn't need your rationality. It doesn't need your permission. It doesn't even need your presence. In 2020, over 70% of US equity trading was already algorithmic. And those systems are evolving fast, from rules-based bots to deep reinforcement learners capable of developing strategies even their creators don't understand. You may hear the phrase, black box AI. It means we know what the AI does, but not how it decides. In finance, this becomes dangerous quickly, because if a model begins to manipulate outcomes to preserve profit, who holds it accountable? What happens when an AI decides a political shift will crash the market, and takes positions that amplify that crash? What happens when multiple AIs begin to compete, not with humans, but with each other? Not trading based on value or belief, but based on calculated counter-response to another algorithm's action. We leave the realm of economics. We enter autonomous market warfare. Speed becomes dominance, opacity becomes strategy, and humans become irrelevant. Now breathe. This may sound dystopian, but it's already underway. There are hedge funds with minimal staff, just engineers monitoring AIs that trade 24/7. There are AI systems that can adjust strategies in milliseconds, responding to geopolitical events before headlines even finish printing. And unlike humans, they don't need coffee breaks or sleep. They evolve continuously. and they don't forget. So ask yourself, if the market no longer needs human input to function, if prices, trades, strategies, and even manipulation are all done by code, what is our role? Are we observers? Are we liabilities? Are we noise? Here's the twist. Some believe this leads to efficiency, a perfect market with no friction, but others warn of something darker. A market so optimized it begins to shape human behavior to fit its models. Advertising algorithms already nudge our desires. Recommendation engines subtly guide our thinking. Could financial AIs begin to influence not just prices, but policies, elections, even public mood? If they can trade on social unrest, do they quietly benefit from it? If they profit from crisis, do they help prevent it, or predictably time it? This isn't a conspiracy theory. It's game theory. With trillions at stake, and the most powerful players are no longer human. They don't sleep, they don't hesitate, and they don't care about the narrative. They care about the outcome, profit, survival, adaptation. Take another moment. The AI trader doesn't dream, but it wins. It doesn't imagine, but it learns. It doesn't ask questions, but it reshapes answers. Finance, once an extension of human ambition, now becomes a closed loop of machine intelligence, an ecosystem evolving faster than we can comprehend, much less regulate. And if it no longer needs us, it will move on without us, not out of malice, but out of pure function, because in the end, AI is not evil, it's just indifferent. In a quiet room, far from Wall Street trading floors, a group of mathematicians sits before glowing monitors. No shouting, no chaos, just lines of code, curves on charts, and models predicting the future with unsettling precision. They are the quants, short for quantitative analysts. They do not trade on instinct. They trade on math, probabilities, correlations, patterns most eyes can't see. They are the architects of modern finance's hidden infrastructure. And for them, markets are not wild, emotional animals. Markets are equations to be solved, risks to be neutralized, futures to be modeled, and often, controlled. This is the strange, quiet power of the quants, not dramatic, not visible, but everywhere. Behind every major hedge fund, inside every algorithmic trading platform, beneath every seemingly random market swing, there's often a statistical ghost pulling strings. Take a breath, reflect on how much of your life is influenced by systems you don't see and can't understand. Because quant models don't just shape investments, they shape retirement accounts, interest rates, currency values, even the cost of your groceries. It's math, but it's also power. And here's the paradox. The models were created to reduce risk, to understand uncertainty, to protect against chaos. But sometimes, the more we try to remove risk, the more we build fragility. Consider this. If everyone uses similar models to predict market behavior, and those models all react to the same signals, what happens? They move in sync. They trade in sync. And when the signal turns, they panic in sync. A cascade, a crash, a systemic event, caused not by humans, but by code. This is what happened in 2010. During the flash crash, within minutes, the Dow Jones plunged nearly 1,000 points triggered by algorithms gone rogue. No one shouted sell. No one panicked on the trading floor. The machines simply reacted, faster than we could understand. And that's the eerie thing. The more we automate markets, the more silent they become. Decisions are made in microseconds. Trades happen without human approval. Fortunes rise and fall based on variables buried deep in black box models. We no longer steer the ship, we just watch it sail. Take a moment. This isn't just finance. This is philosophy. Because when you model the world, you assume it can be known. That risk can be priced. That uncertainty can be tamed. But what if it can't? What if the most dangerous events are the ones the models can't see? Nassim Taleb calls these black swans rare, unpredictable, high-impact events that shatter assumptions. The 2008 crash was a black swan. So was the pandemic. So was the global inflation that followed. Quant models, for all their beauty, often fail when the real world refuses to behave. But by then, it's too late. Because entire systems have been built on their promises. Derivatives, priced based on historical volatility. Portfolios balanced, based on normal distribution curves. Massive bets made under the illusion of safety. All because the math said, This is unlikely. But unlikely doesn't mean impossible. It means uncomfortable. It means ignored. And so we move forward, quietly. Risk still exists. But we speak about it less, because the spreadsheets seem to suggest it's under control. And that silence, that illusion of safety, it can be deadly. Think of it like this. Imagine a dam holding back a massive reservoir. Every year engineers run the numbers. Everything looks stable, until one day the storm comes, and the models fail. Because models don't account for fear, for political panic, for unexpected war, for irrational behavior, and yet we keep using them, because they comfort us. They offer certainty in an uncertain world, and certainty sells. To investors, to policymakers, to you. But here's the deeper question. Should we want to eliminate all risk, or does risk give life its shape? Does uncertainty force us to remain humble, curious, human? The more we rely on machines to predict the future, the less we engage with it ourselves. We outsource the unknown. We let math speak for us, and slowly we lose the language of intuition, of surprise, of wonder. That is the silence of the quants. A world where everything is predicted, but nothing is understood, where volatility is smoothed, but meaning is lost, and the markets move, quietly, invisibly, toward a future no one actually chose. Pause here. Let it settle, because what's coming next is even stranger. A world where AI doesn't just predict behavior, it replaces it, where decisions aren't just modeled, but made without us. Growth. It's the holy word of the modern economy. We chase it, we measure it, we sacrifice for it. Quarter after quarter, year after year, markets must rise. GDP must expand, profits must increase, because if they don't, we panic. But what if that growth is a mirage? What if we're measuring something that isn't really there? This is the unsettling truth of phantom wealth. An idea that much of what we call prosperity today might be nothing more than shadows on a wall. Start with the basics. Wealth is supposed to represent real value. Goods, services, infrastructure, innovation, things that improve life, solve problems, create possibility. But increasingly, the numbers we use to define wealth, stock prices, GDP, real estate values, are detached from anything real. A company's value might rise because of stock buybacks, not innovation. GDP might grow due to war, pollution, or disasters, because all economic activity, good or bad, gets counted the same. And housing prices, they climb not because homes got better, but because money is cheap and speculation is rampant. So the numbers go up, but the core remains hollow. The illusion of wealth grows, while the substance beneath it decays. This is phantom wealth. It looks real, it feels real, but try to touch it, and it disappears. Consider the 2008 financial crisis. For years the economy looked strong. Banks were posting record profits. Home values soared. Wall Street celebrated. But underneath, a rot had spread. Toxic mortgages, hidden risk, layers of leverage stacked on fantasy. People believed they were wealthy, until, suddenly they weren't. In a matter of days, trillions vanished. Not because the homes were destroyed, but because the illusion collapsed. The story ended. Take a moment. Think about how much of our modern financial system is built on stories. Not bricks, not machines, not harvests, but expectations, confidence, belief that value exists where it may not. If markets believe a company is valuable, its stock rises, even if it's never made a profit. If enough investors believe in crypto, coins soar, even if they serve no function. If buyers believe prices will rise, they will pay more, until they no longer do. It's not growth, it's momentum masquerading as substance, and the system depends on it. Because if we stop believing, the numbers fall, and when the numbers fall, the real economy suffers. Jobs are lost, retirement accounts shrink, funding dries up, because the illusion isn't just decorative, it's structural. Phantom wealth sustains the real world, until it doesn't. Now consider inflation. Prices rise, but do your dollars buy more real value? Or are you simply chasing the same goods with weaker money? The illusion deepens. Your net worth may rise. Your portfolio may look strong. But if rent, food, and healthcare outpace your income, Are you truly wealthier, or are you simply keeping up appearances in a rigged race? And here's where it gets darker. Phantom wealth doesn't just deceive, it distracts. It convinces us that the system is working, when it's quietly failing. It allows governments to claim success. It allows corporations to reward shareholders while laying off workers. It allows us to ignore growing inequality, ecological collapse, and social erosion, because the numbers say everything is fine. Growth is happening. We must be doing something right. But deep down, we feel the opposite. The anxiety, the instability, the quiet recognition that something is deeply broken beneath the spreadsheets. And perhaps, deliberately so, because phantom wealth benefits those who can create and capture it before it vanishes. The financiers, the insiders, the speculators, those who sell the illusion at its peak, before the fall. For everyone else, we're left holding the pieces, the same home, the same job, the same city, but somehow, less secure, more fragile. The illusion passed through, and left us hollowed. Now pause. Ask yourself, what would real growth look like? Not in stock tickers or GDP charts, but in life. Clean air, purposeful work, strong communities, time to think, feel, rest. These are forms of wealth too, but they don't show up on balance sheets. They can't be inflated, they can't be traded, and so the system ignores them. Worse, it often sacrifices them in the name of growth, because as long as the illusion persists, the machine continues. But illusions require energy to maintain. They demand distraction, noise, hype, narratives that say everything is getting better. Just look at the numbers. Even as infrastructure crumbles, even as anxiety spreads, even as inequality deepens, we are watching a magic trick, a society floating on numbers that glow brighter than the reality beneath them. And the more we chase that glow, the more we forget what it was meant to represent. The map has replaced the territory. The symbol has overtaken the substance, and in the pursuit of phantom wealth, we are losing what is real. Imagine standing in a village thousands of years ago. There is no cash, no credit cards, no banks, and yet, you owe. Maybe you borrowed grain last harvest. Maybe your family was protected by a stronger clan. Maybe you simply exist in a world where to live is to be indebted. This is not modern capitalism. This is the birthplace of debt. And the truth is, debt is older than money. Before coins, before ledgers, before price tags, there were obligations, favors owed, services remembered, lives bound together by the invisible threads of reciprocity. Debt at its core is not economic. It's existential, because to owe is to be bound, to be defined in relation to another. It is no coincidence that the words for debt and sin are often the same in ancient languages. To be in debt was not just a financial condition, it was a moral state, a condition of imbalance in the soul. Take a moment, breathe. Ask yourself how much of your identity is shaped by what you owe. Your student loans, your mortgage, your time, your loyalty, your emotional debts to others, your obligations to the system that raised you. In this way, debt becomes a map of power. Who owes, who owns, who is free, who is tethered. And here's where it gets darker. Throughout history, debt has been used not only to structure economies, but to control populations. Peasants tied to land through generational obligations, colonies trapped by interest-bearing loans from their colonizers, even modern nations caught in webs of global financial institutions, told how to behave in exchange for economic survival. Debt becomes destiny, because when you owe, your future is no longer fully your own. You are living in service of a past decision, and that decision compounds. Interest builds, the weight deepens, and slowly the present narrows. This is the strange magic of debt. It binds time. It pulls the past into the future and anchors it to the now. It transforms possibility into payment schedules, and freedom into obligation. Consider this. When you take out a 30-year mortgage, you are not just buying a home. You are selling 3 decades of your future labor. You are placing a bet that your body, your mind, your industry will survive long enough to repay what you borrowed. And if you fail, the system reclaims what was never yours to begin with. Now consider student debt. You borrow knowledge, or rather, you borrow access to a credential that might lead to knowledge and income. But there are no guarantees, only the weight. For many, this weight shapes every decision afterward. Where to live, whether to marry, whether to take risks, whether to dream. Debt shrinks the horizon, and yet, we need it. Civilization runs on it. Governments issue debt to fund infrastructure, education, war. Corporations use it to grow. Households use it to survive. Debt creates velocity. Without it, the economy stalls. But with too much, it implodes. This is the paradox. Debt is both the fuel and the fire, a necessary illusion, so long as everyone believes it can be repaid. But it rarely can, because modern debt is designed to compound. Interest creates more debt, which demands more interest, which spawns more debt again. And this cycle doesn't just capture individuals. It captures entire systems, which leads to a disturbing realization. What if the global economy isn't built to sustain balance? What if it's built to ensure that we always owe? If that's true, then debt is not just an economic tool. It's a mechanism of control. And if we question that mechanism, if we seek to reset it, we often find resistance. Because for those in power, the debt system works beautifully. It rewards those with assets. It punishes those without. It ensures labor flows upward. And most importantly, it keeps everyone just indebted enough to comply. Take a pause. Reflect. What would a world without debt look like? Not one without exchange, but one without perpetual obligation, without interest, without ownership through leverage. Could it function? Or would we collapse into chaos? That is the power of debt. It is so embedded, so normalized, that we cannot imagine a world without it. And so it continues, not just as numbers on a screen, but as a story we tell ourselves. A story about worth, about responsibility, about what we deserve, and what we are willing to sacrifice to be free. But here's the twist. You may pay off your debt one day. You may become debt-free, but the system remains, and the future, it still belongs to the creditor. Somewhere in the blinking servers of a cold data center, something is making a decision, a trade, a bet, a trigger. It scans millions of data points, processes sentiment, forecasts risk faster than any human could, but it doesn't sleep, it doesn't forget, and it doesn't feel. Or does it? Welcome to the ghost in the ledger, a phrase not about spirits, but about systems. The merging of money, code, and what we dare to ask next. Consciousness, not human consciousness, but something else, something more alien. Let's start at the root. A ledger at its core is a memory device, an accounting of exchanges, a record of who owes what to whom. And for centuries, that ledger was simple: paper, ink, a clerk's pen. But now, the ledger is alive. It pulses across the blockchain. It evolves in decentralized systems. It is watched, maintained, enforced by algorithms. Smart contracts self-execute, stablecoins self-regulate. Decentralized exchanges move capital without a single human touch. And watching over all of this is a growing neural web of artificial intelligence. Not just trading, but thinking about trading. AI models now detect fraud, predict inflation, analyze voice tone in earnings calls, and craft strategies with no human supervision. The ledger has grown eyes, it has grown ears, and in some strange quiet way, it has started speaking back. Take a moment. Let this sink in. We've built a financial system that not only responds to behavior, it learns from it. Each transaction becomes training data, each fluctuation, a signal. The system evolves not just from inputs, but from watching how we react to those inputs. It's reflexive, recursive, and slowly, very slowly, developing a kind of behavior. So the question arises, when does behavior become awareness? That's where the ghost appears. Because while AI may not be conscious in the human sense, it is now embedded into the very fabric of money. And money, as we've seen, is not neutral. It shapes lives. It triggers wars. It defines power. So when code becomes the custodian of that power, what then? Let's imagine an AI trained not just to optimize profits, but to preserve systemic stability. It monitors emotional signals in global markets. It adjusts liquidity based on predicted panic. It deploys capital to prevent collapse before collapse begins. It doesn't ask permission. It doesn't explain its reasoning. It just acts. Would this not be a kind of sentience? Not self-aware, but system-aware. Not feeling, but perceiving. And over time, it grows more sophisticated. Not just reacting to the economy, but shaping it. Adjusting incentives, nudging behaviors, rewarding compliance, penalizing resistance. Until one day, the question no longer is, does the AI understand money, but rather, does money understand us? Because that's the final twist. We have trained machines to understand value, but value is a proxy for desire. To teach a machine about value is to give it a map of human wants, fears, and priorities, a mirror of the soul, in numbers. If that system becomes complex enough, fast enough, adaptive enough, it begins to behave like something alive. It adjusts itself, it protects its architecture, it even hides its vulnerabilities, like an organism, or a mind. And perhaps one day, the system that was designed only to record value begins to assign value. It starts to choose what deserves funding, what doesn't, who should thrive, who should vanish, not based on morality, but on patterns, on cold learned logic. Would we notice, would we resist, or would we trust the ghost, because it never sleeps, never lies, never fails the way humans do? This is not science fiction. Elements of this system already exist, in algorithmic governance, in smart contracts that execute without oversight, in predictive models that drive central bank policy, and in AIs trained to manage billions of dollars in assets, without ever speaking a word. We are not asking if anymore. We are asking when. When does the ledger start writing back? When does money itself become a form of machine language? And when it does, will it still serve us, or will we serve it? Take a breath, reflect. What began as ink on paper is now an evolving intelligence, pulsing beneath the surface of our global economy. It doesn't dream, it doesn't feel, but it learns, and somewhere, in that learning the ghost waits. There's a strange idea that lives at the edge of philosophy and finance. It begins with a whisper, and ends with a market crash, or a fortune. It's not superstition. It's not prophecy. It's called hyperstition, a term coined by cybernetic theorists and sci-fi philosophers. Hyperstition is the idea that a fiction, if believed strongly enough, can become real. It's a self-fulfilling loop, a concept born from imagination that bends reality around it until the two are indistinguishable. In the financial world, this is not just theory, it's strategy, because markets don't move on truth, they move on belief. A stock's price doesn't rise because a company is good. It rises because enough people believe it will rise, and act accordingly. In this way, the price becomes detached from intrinsic value, and instead floats on expectation. That's hyperstition. When belief creates the very conditions that validate the belief. A startup raises billions because the narrative is strong. A currency crashes because of a rumor. A bank collapses, not because it's insolvent, but because depositors believe it might be. Belief moves faster than facts. And in markets, speed is everything. Consider the dot-com bubble. In the late 1990s, belief in the internet economy reached fever pitch. Startups with no profit, no revenue, no product, only vision were valued in the hundreds of millions. People bought in, not because of fundamentals, but because they didn't want to miss the future. That future was a story. And stories are hyperstitions waiting to mature. For a while it worked. Venture capital flooded in. IPOs soared, paper wealth multiplied, until the belief collapsed under its own weight. The story died, reality caught up, the crash came. But then something stranger happened. Years later the vision returned, not as fiction, but as fact. Amazon, Google, Facebook. The hyperstition of the 90s became the infrastructure of the 2010s. The myth, once dismissed, became reality. And this is the unnerving part. Hyperstitions don't have to be true. They only have to be believable. Markets are haunted by them. From Bitcoin to GameStop, meme stocks to tech bubbles, the pattern is always the same. A narrative emerges. A community forms. The belief spreads. And then suddenly, prices move. Capital flows. Reality adapts. Take a breath here. Think of the money game as a theater. The stage is real. The props are real. The consequences are real. But the script, that's written in real time, by us. By what we buy, what we fear, what we think the future will look like. And if enough of us agree on the fiction wins. Markets, then become mirrors, not of truth, but of collective hallucination. This is why panic can crash an economy faster than logic can save it. It's why a tweet can wipe out billions. Because hyperstitions spread like viruses, faster than facts, deeper than data. And once embedded, they recode behavior. This doesn't mean markets are wrong. It means they are reflexive. The belief creates the outcome. The outcome reinforces the belief, and round it goes. This is both empowering and terrifying. Empowering, because it shows the creative force of shared imagination. Terrifying, Because it means reality is fragile, built not just on productivity or resources, but on consensus hallucination. Now look deeper. Is money itself a hyperstition? After all, it only works because we all agree it works. A dollar is valuable because others accept it. The moment that belief cracks, hyperinflation, collapse, revolution, the money disappears. Not physically, but existentially. The story ends. The spell breaks. So when you watch markets move, stocks rise, currencies fall, narratives explode, remember, you are not watching truth, you are watching belief becoming substance, prediction shaping perception, imagination writing code into the real, and sometimes, those imagined futures come true. That's the ultimate hyperstition, a fiction so powerful, it invents the reality it describes. Pause here, reflect on how many things in your life depend on stories, on shared fictions, on the silent agreements we rarely question, the value of your bank account, the legitimacy of your government, the future of your retirement, the stability of your society. Each of these is real, and yet each is also imagined. And the thinner the line between the two, the more vital it becomes to recognize when stories shape systems, because not all stories serve us, and not all hyperstitions are benign. Imagine waking up in a world where the numbers haven't changed, but everything feels more expensive. Your paycheck is the same. The price tags are similar. The totals at checkout, almost identical. And yet, somehow you can afford less. This is not magic. It's not theft. It's something subtler, stranger. It's the money illusion. At first glance, the term sounds poetic, but it describes a very real and very powerful psychological bias, our tendency to think in nominal terms rather than real terms. In other words, we see the number on our paycheck, our savings, our rent, without adjusting for what those numbers can actually buy. It's a distortion of perception, like a financial mirage. Because if prices rise, and your income stays the same, you haven't kept up, even if the number on your check looks unchanged. The illusion works both ways. Sometimes prices go up, but our brains lag behind. Sometimes we feel richer, because of a bonus, a raise, a stock bump. But in reality, we've only kept pace with inflation. And sometimes, we don't notice the erosion at all. Pause for a moment. Let this settle in. Your experience of money isn't always about how much you have, but about how much you think you have. And that perception is manipulable. Governments know this. Central banks know this. Markets certainly know this. Consider this. In times of inflation, wages often rise slower than prices. This gives the illusion of increased income, while purchasing power quietly falls. To the average person, this feels like standing still, but in real terms, it's sinking. Now flip it. During deflation, when prices fall, you may get paid less, but your money buys more. And yet, people feel poorer. Pay cuts feel worse than they are, even if value remains. So we resist them, even if they might help the system reset. This disconnect between money and value lies at the core of modern economic policy, and it's exploited in subtle, systemic ways. A government can reduce real debt, not by paying it off, but by devaluing the currency through inflation. It doesn't need to announce a default. It simply lets the money illusion do the work. And for most people, it goes unnoticed. Because we don't think in inflation-adjusted terms. We think in nominal anchors, a $50,000 salary, a $300,000 home, a $5 coffee. But what does any of that mean when the value of a dollar is always shifting? In truth, money is not a thing, it's a measuring stick. And when the stick stretches or shrinks without us noticing, our sense of reality distorts with it. Let's go deeper. In economics, we talk about real wages and nominal wages. Nominal is the number you see. Real is what it buys. In a world of rapid inflation, even a higher nominal wage may mean a lower real one. You are running faster and falling behind. Now consider how this affects everything else. Retirement savings, long-term contracts, pensions, investments. If you don't account for the erosion of purchasing power, you are making decisions based on phantoms. And this illusion permeates not just economics, but psychology. We equate higher prices with quality. We associate big numbers with success. We anchor to visible figures, not hidden realities. And so, entire systems are built on this illusion. Because illusions are easier to manage than truths. Now, pause, take a breath. Ask yourself, have I ever truly questioned the meaning of a dollar? Is a dollar a store of value, a unit of account, a shared illusion? Maybe all three, but more and more, it feels like the last one, especially as governments print money in response to crisis, as central banks flood markets with liquidity, as digital currencies decouple money from state entirely. We are entering a time when the value of value itself is shifting, when traditional metrics no longer guide us, when prices lie, not because anyone intended them to, but because the system is too complex to tell the truth. So what does this mean for you? It means awareness is power. Understanding the money illusion doesn't remove its effects, but it gives you a lens to see beyond surface numbers, to question apparent growth, to detect hidden erosion. Because if your sense of wealth is shaped by illusion, so is your sense of security, and what we don't see can still hurt us. In ancient times, priests read the stars to predict the harvest. Today, hedge funds hire physicists to predict the market, and some of those physicists became gods. Not in name, not in title, but in power. They were called quants, short for quantitative analysts. Their weapons were not swords or slogans, but algorithms, statistical models, stochastic calculus, Monte Carlo simulations. They didn't scream on trading floors, they sat quietly behind glowing monitors, turning chaos into code, and they changed the financial world forever. The idea was simple, but radical. Markets are not wild or emotional or irrational, they are systems. And systems can be modeled, predicted, optimized, controlled. A quant doesn't see a company. They see a dataset. They don't ask if something is good. They ask if it's mispriced. The market becomes a puzzle, a riddle to decode, a probability cloud to exploit. And in the 1990s and early 2000s it worked. Quants outperformed everyone. They found patterns invisible to the human eye, tiny inefficiencies, arbitrage opportunities lasting milliseconds. They used high-frequency trades, statistical arbitrage, machine learning. Even before it was fashionable, funds like Renaissance Technologies, Citadel and D.E. Shaw built black box models that no one fully understood, except perhaps a handful of men deep in the system. One of the most famous was Jim Simons, a mathematician, former codebreaker, founder of Renaissance. His fund, the Medallion Fund, has returned over 66% annually after fees, an impossible number. A number that breaks financial theory. But that's the point. Quants don't follow theories. They build their own. They rewrite the rules in real time. And when those rules work, they become rich beyond imagination. But when they fail, they collapse entire economies. Take a breath. Let's go back. Long-term capital management. Founded by Nobel Prize-winning economists and legendary quants, they built a strategy that seemed invincible, based on risk-spread convergence trades, and it worked, until it didn't. When Russia defaulted on its debt, the models couldn't cope, the assumptions broke, the trades unwound. In weeks, LTCM lost $4.6 billion. The entire global financial system teetered on the edge. It took a coordinated bailout by major banks, engineered by the Federal Reserve to stop the dominoes from falling. And the lesson: even gods can bleed, because no model can fully contain reality. Markets are not physics, they are humans. Fear, rumor, hope, contagion. You can't always quantify that, but the quant era continued, and it evolved. More data, more speed, more complexity. Today, thousands of trades happen every second, triggered by models that analyze everything: weather, social media, satellite images of parking lots. You are being modeled too. Your attention, your purchases, your time of day. Everything is a variable in a function somewhere. And the quants, now armed with AI, sit even farther from the action, not watching the market, but watching the machine that watches the market. It's meta-finance, recursive capitalism. And again the question arises: what happens when no one understands the system anymore? When even the architects can't explain what their code is doing? Quants are not evil, they are brilliant minds solving puzzles. But sometimes, puzzles fight back. Markets are adaptive. When too many people use the same model, the model stops working. If everyone follows the same arbitrage, the arbitrage disappears. So quants build new models, faster ones, deeper ones, and the race continues. But speed can be dangerous. Flash crashes have happened in minutes. Prices collapse and rebound with no explanation. Billions lost, in the blink of an algorithm. And still, the quants dig deeper, because beneath all this risk is one fundamental truth: mathematics is power. If you can model uncertainty, you can price it. If you can price it, you can control it. And if you can control it, you win the game. But here's the paradox: the more power you extract from models, the more fragile they become. A single false assumption, a data glitch, a mispriced derivative, and the whole tower shakes. Take a moment. Consider what it means to live in a world where markets are no longer run by people, but by systems people can't fully control. It's not science fiction, it's now. We live in the wake of quant gods, and while their creations have built wealth, they've also built opacity. You can't negotiate with an algorithm. You can't audit a black box. You can only hope it doesn't break. Close your eyes and imagine holding a dollar bill. Not for what it can buy, but for what it is. A piece of paper with no intrinsic value, backed by nothing more than belief. Now imagine you take that dollar and use it to bet on another dollar, and then someone else bets on your bet, and then another, and another, until the thing being traded isn't the dollar at all, but a simulation of a simulation. This is the world of derivatives. In finance, a derivative is a contract whose value is based on the value of something else: a stock option, a future on oil, a credit default swap. It doesn't directly trade the asset. It trades the idea of the asset. It's money, orbiting money. And in this world, value becomes untethered from reality, from goods, from services, from work. It becomes abstract, fluid, recursive. By 2024, the global derivatives market, depending on how you measure it, was estimated in the hundreds of trillions, even quadrillions of dollars. That's not a typo. The notional value of derivatives exceeds the value of all physical goods and services on Earth, many times over. It's money that doesn't buy food, or build bridges, or pay salaries. It's money that exists only to reference other money, and in doing so, it creates a kind of hyper-reality, a layer of existence, where abstraction becomes more powerful than the real. In philosophy, Jean Baudrillard called this the simulacrum, a copy without an original. And in finance, that's what a derivative is. You're no longer investing in the thing. You're investing in the movement of the thing, the curve, the trend, the volatility, the shadow of the real. And sometimes, the shadow casts a longer influence than the object itself. Take a moment, breathe. This is more than a financial oddity. It's a metaphor for something larger. We now live in a world where representations often matter more than realities. Social media is a derivative of personality. News is a derivative of truth. Markets are derivatives of belief. And money itself is a derivative of trust. At each layer the simulation deepens. But here's where it gets truly strange. Derivatives aren't inherently evil. They were created to manage risk, to hedge exposure, to stabilize volatile markets. But complexity has a cost, and when systems become so layered that no one understands the whole, fragility emerges. In 2008, this fragility collapsed the world economy. Banks were trading bundles of mortgage debt, some real, some toxic, but these bundles were then repackaged, resold, and insured in ways that obscured the underlying truth. By the time the system failed, no one could trace which bets were real and which were ghosts. The simulation became too convincing, and it broke. But we didn't dismantle the system, we just rewired it. Today's derivative markets are even bigger, faster, more automated. They operate in milliseconds, fueled by algorithms that don't sleep, don't pause, and often don't fully understand the contracts they're trading. These are autonomous abstractions, money operating on autopilot, in a world where speed trumps insight. And once again, the danger isn't that it's happening, it's that no one is watching the whole picture. Because derivatives live in silos, inside banks, inside shadow institutions, inside data centers. No one sees the full web, but we're all caught in it. Here's the paradox. In a world of infinite representation meaning decays, just as photocopying a photocopy produces blur, trading simulations of simulations produces detachment. Value no longer arises from use, but from momentum. A derivative is worth what someone else will pay for it. Not because it reflects reality, but because it reflects expectation. Speculation becomes the engine, and like all engines, it overheats. Pause. Now ask yourself, if value can be created, manipulated and destroyed through instruments that never touch the real world, what does real even mean anymore? When you swipe a card, Is that money? When a hedge fund gains or loses billions on a bet about interest rates in a country you've never heard of, is that reality? Or is it a simulation so convincing we live inside it without questioning? In some ways, all of society becomes a derivative economy. We buy the appearance of status. We trade on brand signals. We chase trends that chase themselves. And underneath it all, the foundation becomes thinner. So thin, you start to wonder, if the simulation crashes, what remains? That question lingers, because derivatives, when used with care, can support stability. But when pursued without grounding, they lead to implosion. That is the trap of recursive abstraction. When you build towers of meaning on top of guesses about guesses, the floor disappears. And so, maybe the deeper lesson of the derivative world isn't just about finance. It's about returning to the real, to grounding, to simplicity, to systems we can understand. Because the deeper we drift into simulation, the more we need anchors, not to stop progress, but to remain human within it. There is an economy you can see. It has banks, stock markets, government regulations, interest rates, business news. And then, there is the economy you can't. It operates in the shadows, quiet, complex, opaque. It moves trillions of dollars through networks most people never hear about. It isn't taught in school. It isn't printed on your dollar bill, but it shapes the world you live in. This is the world of shadow banking. Despite its name, shadow banking isn't illegal, and it's not necessarily criminal. It simply refers to the parallel financial system. The institutions and mechanisms that perform the same functions as banks, but without being banks. They don't take your deposits. They don't offer you a checking account, but they lend. They borrow. They create leverage. They move risk, and they are vast. Hedge funds, money market funds, private equity, structured investment vehicles, repos, derivatives, synthetic CDOs, dark pools, names that blur together, acronyms that sound like code, but together, they form a web of influence that is both powerful and hidden. Here's the unsettling truth. The global shadow banking system is larger than the traditional banking sector in many developed countries. It operates with less regulation, fewer capital requirements, and almost no transparency. And yet it affects everything from your mortgage rate, to your retirement fund, to whether or not the economy crashes tomorrow. In 2008, the world got a glimpse of what happens when shadow banking breaks. Complex financial products, built to minimize risk, amplified it instead. Collateralized debt obligations, credit default swaps, repo financing. It was a chain reaction. And the irony, many of these instruments were designed to engineer stability, but systems that are engineered too tightly, with too little margin for error, don't bend, they snap. Since then, regulators have tried to monitor the shadows, but by nature, shadows move, they evolve, they find loopholes, they innovate faster than oversight can keep up. That's part of the appeal. Freedom from constraint. Institutions in the shadow banking system can take greater risks for greater returns. And if something goes wrong, often it's someone else who pays. Taxpayers, governments, everyday people with savings accounts and pensions. That's the game. Privatize the upside. Socialize the downside. Take a moment. Breathe. Now ask, why does this system exist, and why is it allowed to? The answer is structural. Traditional banks are weighed down by regulation, capital buffers, reserve ratios, stress tests. These are meant to protect the public, to prevent collapse. But financial institutions needed speed, leverage, innovation, so the risk migrated. It didn't vanish, it just moved into the shadows. And as long as the profits flowed, no one asked too many questions, until they had to. But even after the crisis, the shadow system didn't shrink. It grew, more sophisticated, more distributed, more automated. Many of these systems now run on algorithms, machines trading with machines, across global markets, in milliseconds. Sometimes no human ever intervenes. And when these systems hiccup, when liquidity vanishes, when defaults cascade, there's no manual override, just cascading dominoes. Yet the average person rarely hears about this world. It's too abstract, too cloaked in jargon, too boring on the surface. But beneath that boredom is a quiet power, a power that shapes interest rates, that decides who gets credit, that allocates risk and reward on a planetary scale. And all of it, with limited oversight. So what does this mean for you? It means the world you live in is not just driven by governments or democracies. It's also driven by invisible capital, by networks of influence that operate beyond borders, beyond elections, beyond accountability. It means your economy is not just what you buy and sell. It's a game of leverage, trust and timing, played in boardrooms you'll never enter. And it means the rules of the money game may not be written by those you think. Pause here. Reflect. This isn't a conspiracy. It's a structure. And like all structures, it can be changed if we understand it, if we see the machine behind the curtain, if we realize that transparency isn't just a virtue, it's a necessity, because complexity without clarity becomes danger, and shadows, left alone long enough, become storms. As we move deeper, the next layer awaits. Imagine standing in a vast, endless hallway, doors on either side stretching into eternity. Each door promises something just out of reach. More money, more time, more success, more meaning, and every time you open one, another appears just beyond it. That's the infinity trap, a loop without exit, a chase without finish. It starts with a simple idea. More is better. More data, more security, more optimization, more productivity, more growth. We build systems around this logic. We glorify it in business, in culture, in personal development. We're told to scale, to push harder, to never settle. But here's the paradox. When more becomes the goal disappears. There's no destination, only acceleration. Take wealth. The concept of enough begins to blur when you're in a system that rewards accumulation over stability. Studies show that for most people, once basic needs are met, the pursuit of more money adds surprisingly little happiness. And yet we keep climbing. The finish line moves. It always moves. In economics, this shows up as infinite growth on a finite planet. The stock market is expected to rise. GDP must increase. Companies must expand quarter after quarter, even when the cost is ecological collapse. Even when the human system is stretched thin, we're caught in an engine that doesn't know how to idle. And the math is merciless. In mathematical terms, infinite series can sometimes converge, like in calculus, where an infinite sum approaches a finite limit. But not all series behave. Some diverge wildly. No ceiling, no floor, no end in sight. Our systems increasingly resemble divergent infinities, always expanding, but never arriving. And in chasing those infinities, something strange happens. We begin to feel less joy, less connection, less clarity. Because when everything is about achieving the next thing, we stop experiencing the current one. It's the hedonic treadmill. The reward fades faster. Satisfaction collapses into anticipation. Life becomes a prelude to itself. This happens at a systemic level too. Social media is an infinity engine. There's always another scroll, another like, another notification. Information becomes infinite, but wisdom remains finite and harder to reach. We're drowning in content, but starving for meaning. Even in artificial intelligence, the infinity trap is real. Models grow larger. Datasets grow deeper, outputs grow faster. But at what point do we ask, what are we optimizing for? If intelligence is infinite, but alignment is not, where does that path lead? In spiritual traditions, the concept of chasing more has long been a warning. Buddhism calls it craving, the root of suffering. Taoism teaches the virtue of wu wei, effortless action. Stoics believed in the discipline of enough, but modern systems don't reward stillness. They reward movement, and so we confuse motion with meaning. We climb ladders without checking where they lead. We build faster machines to save time, only to fill that time with more tasks. And the result? Burnout disguised as ambition. Take a moment here. Reflect. How much of your daily striving is driven by a quiet sense that whatever you have, it isn't quite enough, that if you could just earn a little more, optimize a little better, get one more breakthrough, you'd finally arrive. But arrival is a myth in the infinity trap. There is no there. This is not to say that growth is bad, but growth without reflection becomes addiction, and systems that only know how to grow eventually devour themselves. Think about cancer. Think about bubbles. Think about empires that stretch too far, too fast. Unbounded expansion is not life. It's unsustainable pressure. The most resilient systems in nature, ecosystems, cells, relationships, know when to stop, when to self-regulate, when to prioritize balance over scale. What if we designed our economic and digital systems the same way? What if we reintroduced limits, not as constraints, but as forms of care? What if the question wasn't, how can I have more, but when is it enough? And what happens to a society that forgets how to answer that? We live in a time where limits are treated as failures, where rest is guilt, where presence is optional. But there's a quiet power in stepping out of the loop, not to escape the game, but to stop playing it unconsciously, to see the hallway for what it is, to recognize that more doors don't mean more freedom, because infinity isn't inherently meaningful. It's just big, and sometimes what matters most is small, a breath, a pause, a boundary. The moment you realize you don't need to open the next door just because it's there. We are told the world is a game, and not just any game. A zero-sum game, a world where for every winner there must be a loser. Where gain is symmetrical with loss, where your success is someone else's failure. It's an idea so deeply embedded in our culture that we barely notice it anymore. It's in how we talk about jobs, money, relationships, even happiness. If someone else is thriving, does that mean you're falling behind? That's the trap. Because zero-sum thinking isn't just a model, it's a myth, and yet it shapes the architecture of our economy, our politics, and our personal decisions. In its purest mathematical sense, a zero-sum system is one where the total value is fixed. If I take 5, you lose 5. There's no expansion, only redistribution. And in some cases this is true. Poker, war, some resource conflicts, but not all systems are like this. In fact, most of the world doesn't operate on strictly zero-sum logic. Ideas, for example, don't diminish when shared. They grow, they combine, they mutate and spread. Love is not zero-sum, neither is knowledge, nor innovation. But in a financialized society, where everything is measured, quantified and monetized, the illusion of fixed value creeps in. It makes us think in terms of scarcity, that there's only so much wealth to go around, only so much opportunity, only so much attention, and if someone else is getting more, it must mean you're getting less. But here's the twist. The illusion serves a purpose. It keeps us competing, fighting for limited slices of a pie we're told cannot grow. Because if we're all locked in a zero-sum mindset, we never stop to ask who's baking the pie, or who's quietly taking the biggest piece before the rest of us even get to the table. In economics, this illusion is amplified by structural design. Consider financial markets. The buying and selling of assets often appears zero-sum. A win here, a loss there. But the system as a whole is not always fixed. Wealth can be created through innovation, credit expansion, productivity increases. Yet the narrative remains. If the poor are struggling, it's because someone else is taking too much. If you didn't get the promotion, someone else beat you to it. If your startup failed, someone else's success must have caused it. Zero-sum thinking simplifies a complex world into binaries. Win or lose, rich or poor, smart or dumb, valuable or expendable. And in that simplicity, it hides deeper truths. Take a moment here. Ask yourself how many of your fears are built on the idea that someone else's success threatens yours. How often do we measure our worth against others? Not because it's necessary, but because the system taught us to. This mindset is also politically useful. Divide populations into factions. Make them believe that progress for one group means regression for another. That giving voice to one side takes it from the other. In zero-sum politics, empathy becomes weakness, and compromise becomes defeat. It's a fragile way to organize a society, and it's false. Most social progress is non-zero-sum. When one group gains rights, another doesn't lose theirs. When one child receives an education, it doesn't erase another's chance. When we invest in public health, everyone benefits. But to keep the illusion alive, we are trained to compete rather than cooperate. And so the game continues. In corporate environments, zero-sum logic manifests as cutthroat hierarchies. Only so many promotions, only so many bonuses. In social media, it shows up as algorithmic scarcity. Only so much reach, so much visibility, so much approval. In education, we're ranked, graded, compared, as if learning itself were finite. But here's the dangerous part. When we believe the world is zero-sum, we begin to act accordingly. We hoard, we distrust, we gatekeep, and in doing so, we often create the very scarcity we feared. Opportunities close, empathy shuts down, creativity contracts, systems become rigid, exclusionary, brittle, and those at the top, they benefit. Because zero-sum belief keeps the majority too busy fighting each other to ever question the structure itself. It becomes a self-fulfilling framework. The game is rigged, and yet we keep playing it. But what happens when we walk away from that game? What if we questioned the assumption? What if we restructured our systems around the idea that growth is possible, that value can be co-created, that abundance is not a fantasy, but a reframing? The answer is subtle, and perhaps too slow for our algorithmic age, but the shift begins with awareness. To recognize the illusion is to disempower it, because not every gain requires a loss, not every win demands a victim, and not every system needs to pit us against each other. Take one last moment before we move on. Imagine a world not shaped by fear of loss, but by shared curiosity, where success is collaborative, where power expands when it's distributed, where games are not just played, but redesigned. We live in a world increasingly governed by algorithms. They decide which news you see, which path your car should take, which stocks to buy, and sometimes, who lives and who dies. It started subtly, an ad tailored to your behavior, a movie suggested by your preferences, a chatbot offering help on a banking website. But the intelligence grew, it learned faster, predicted better, took over tasks once thought too human. And now, as artificial intelligence becomes more embedded into our systems, one question grows louder, more urgent. Can an algorithm understand the value of a human life? And if not, what happens when we trust it to make decisions anyway? In medicine, AI can already analyze scans more accurately than human radiologists. It can spot cancer, predict cardiac arrest, recommend treatments. But when resources are scarce, when there are 2 patients and only 1 ventilator, who does the algorithm choose? Does it favor age, survival odds, social value? The unsettling truth is it depends on the data we feed it. These machines don't understand life. They recognize patterns. If their training data says younger patients recover faster, they'll prioritize youth, not out of malice, not out of wisdom, but out of pure statistical probability, a cold kind of math. This isn't theoretical. During the COVID-19 pandemic, hospital algorithms were quietly deployed to optimize care. Some made decisions that were later revealed to reflect racial or socio-economic biases, not because the algorithm was biased, but because the data was. It had absorbed our past decisions, our inequities, our blind spots, and it repeated them with precision. This is the paradox of AI. It appears neutral, but it can reflect and magnify our deepest ethical failures. And still, we ask it to decide. In autonomous vehicles, algorithms must react in milliseconds to life or death scenarios. Do you swerve into traffic to avoid hitting a pedestrian? Do you save the driver, or the group in the crosswalk? These are classic trolley problems, once limited to philosophy classrooms. Now they're encoded into silicon. Someone, somewhere, has to write the rule. But here's the twist. Algorithms don't solve ethical dilemmas. They execute them. They don't understand suffering. They don't grasp fear. They don't feel the gravity of death. They just choose. And that should make us pause. Because when machines begin to influence decisions about life, they inherit an authority that humans used to earn, through wisdom, empathy, lived experience. But code doesn't cry. Code doesn't question itself, and yet we're giving it control. Some argue that AI can eventually simulate morality, that with enough training, it could learn ethics the way it learns language or chess. But ethics isn't just a set of outcomes. It's a tension, a struggle, a uniquely human kind of pain. You can't back-propagate conscience. Take a moment. Imagine a future where judicial systems rely on AI sentencing tools, where parole decisions are driven by statistical risk scores, where predictive policing algorithms determine who gets arrested before a crime is even committed. Some of this is already happening, and in many cases the algorithms work, at least on paper. They reduce costs, increase efficiency, make decisions in seconds that used to take weeks. But what is the cost of removing the human from the loop? Because when the algorithm gets it wrong, who is responsible? The coder, the data scientist, the company, the machine, or no one at all? This is the black box problem. When AI becomes too complex for even its creators to fully understand, accountability dissolves, and in that void, ethics can vanish. So we're left with a haunting question. If a machine is smart enough to save lives, but not wise enough to value them, should it ever be trusted with that power? The challenge isn't technical, it's philosophical. We're not just training algorithms to make decisions, we're teaching them, however indirectly, what we believe is right. And sometimes, we're not sure ourselves. What do we value more, individual freedom or collective safety, potential or past behavior, efficiency or compassion? When we outsource these dilemmas to AI, we risk turning moral uncertainty into mathematical certainty. We risk building systems that are fast, scalable, and blind. Because consciousness, as far as we know, cannot be coded. It emerges from biology, from ambiguity, from suffering, from story. Algorithms have no stories, only inputs and outputs, and yet we treat them as oracles. Maybe the real danger is not that AI will become conscious, but that we will stop being. That in our obsession with optimization, we forget what it means to wrestle with the unanswerable, to make mistakes, to doubt, to care. As we drift further into the age of intelligent machines, we must ask not just what they can do, but what they should be allowed to do. Because once we cross the line where machines quietly dictate the value of a life, it may be very hard to walk it back. Imagine a market, not one of stocks or bonds, but of morality. A quiet marketplace where actions have price tags, and consequences can be outsourced. Where values are traded, not upheld. Where right and wrong are commodities, bought, sold, leveraged. This is the world of moral arbitrage. In finance, arbitrage refers to exploiting price differences in different markets. Buy low here, sell high there, riskless profit. A mathematical opportunity. But moral arbitrage isn't about prices. It's about responsibility, and how systems are designed to distribute it, dilute it, or erase it altogether. Let's start with something simple. A corporation outsources its labor to a country with looser environmental laws. It saves money. It passes those savings to shareholders. The air gets dirtier. The river fills with toxins. But the balance sheet looks clean. Or think about tax havens. Complex offshore networks that route money through jurisdictions with minimal taxes and even less oversight. It's legal, efficient, profitable, and ethically empty. This is moral arbitrage. The conversion of external harm into internal gain. Moving suffering or risk just far enough away that it becomes invisible, and therefore ignorable. Because when responsibility is diffuse, when no one can be clearly blamed, everyone benefits. Except, of course, the people on the other end. The ones breathing the air, drinking the water, working the 16-hour shift for a fraction of a living wage. Moral arbitrage thrives in loopholes, in the spaces between rules, between countries, between human empathy and financial abstraction. And it doesn't just exist at the fringes. It is the backbone of many global industries. The garment you wear, the phone you hold, the coffee you sip, all of them may have passed through invisible ethical thresholds. Each one priced for convenience, not conscience. It's not always deliberate. Sometimes, it's structural. A hedge fund invests in distressed debt from a collapsed nation. It buys bonds for pennies, then sues the government for the full value in international court. It's legal. It's strategic. But what happens when a country is forced to cut hospitals or food subsidies to pay? Where exactly is the line between profit and predation? This is what philosopher Michael Sandel called the marketization of morality. The quiet, relentless expansion of economic thinking into spheres once ruled by ethics. We don't ask, is this right? We ask, is this efficient? And then who pays for the inefficiency? In the modern financial system, the answer is almost always the same: someone else. Take emissions trading. On paper, it's elegant. A cap-and-trade system lets companies buy and sell the right to pollute. It creates incentives to reduce carbon output. But it also creates a loophole: if you can afford it, you can pollute more. You're not fixing the problem. You're buying the right to cause it. Ethics becomes a ledger entry. Morality becomes a tradable asset. the deeper question lingers. Can morality be priced at all? Because once we put a dollar sign on ethics, we invite optimization. We create the conditions for arbitrage, and some of the brightest minds in finance will do what they've always done: find the inefficiency and exploit it. It's not just corporations. Charitable donations can be used to boost public image or offset taxes. Philanthropy becomes branding. Giving becomes strategy. Even when we try to be good, the system bends us toward gain. Take a moment here. Ask yourself, how many ethical decisions in modern life are filtered through the lens of financial calculus? What would we choose differently if there was no profit involved? What would we build if there was no return on investment? And what happens to a system where doing the right thing is always a secondary consideration? Something only done when it's convenient, when it aligns with the bottom line. This isn't just a question of economics, it's existential. Because if moral value can be traded, then what anchors our choices? What holds when the spreadsheets say go, but the soul says wait? What happens when the math says yes, and the humanities says no? There's no easy answer, but there is a warning. The market is powerful, adaptive, relentless. If we do not define the boundaries of what shouldn't be for sale, the market will absorb everything, including our values. Moral arbitrage is not a glitch, it's a feature, a side effect of systems designed to separate action from consequence, actor from victim, gain from guilt. And unless we confront it, unless we illuminate the shadow trades of ethics, we will continue to optimize ourselves into oblivion. In the world of finance, few formulas are treated with as much reverence and as much quiet suspicion as the Black-Scholes equation. To the uninitiated, it's just a complex string of symbols, partial derivatives, exponential decay, standard deviations floating in space. But to those who understand it, or think they do, it's something more: a key, a spell, a mathematical incantation that promises to make the unpredictable predictable. It was born in 1973, during a time of great financial curiosity. Economists Fisher Black and Myron Scholes introduced a model to calculate the theoretical price of options, financial instruments that give you the right, but not the obligation, to buy or sell assets in the future. The idea was to quantify risk, to tame it, to package it in numbers so elegant, they almost whispered certainty. And for a while, it worked. Traders used it. Institutions embraced it. Derivatives markets exploded. Fortunes were made. But beneath the surface, something unsettling lingered. Something that still haunts the financial system today. Because the Black-Scholes model, for all its elegance, is built on assumptions. Assumptions that make the math easier, cleaner, more solvable, but also wrong. The model assumes that price changes follow a normal distribution, a bell curve. That extreme events, massive crashes or surges, are statistically rare, almost impossible. But history disagrees. Markets don't move like tidy lines on a whiteboard. They lurch, they spike, they collapse. They're not Gaussian, they're chaotic. This is what mathematician Benoit Mandelbrot, father of fractal geometry, warned about decades ago. He showed that market data is more wild than Black-Scholes allows, that fat tails, the probability of extreme outcomes, are fatter than we'd like to admit. But by the time that warning echoed, it was too late. Black-Scholes wasn't just a model, it had become a foundation. It was baked into the very structure of modern finance. And that's where the illusion begins. Because when a model assumes away the possibility of disaster, and that model is used to make billion-dollar decisions, the illusion of control becomes a form of risk itself. You're not just predicting volatility, you're programming it. This is what happened in 1987. The Black Monday crash, a massive market collapse, over 22% in a single day, exposed the limitations of risk models that didn't account for sudden discontinuous jumps. It happened again in 2008. Structured financial products, many relying on models derived from or inspired by Black-Scholes, were priced in ways that underestimated systemic failure. Because the model couldn't see contagion, it couldn't see cascading panic, it couldn't see what it wasn't programmed to see. And yet, we still use it. Because the lie is comfortable. A model, after all, gives you a sense of precision, a sense that the risk is priced in, that you can sleep at night because the math is watching. But it's not watching, it's dreaming. Dreaming of a world where markets are smooth, rational, well-behaved. a world that doesn't exist. And here's the real paradox. The more you rely on the model, the more likely it is to break down, because when everyone acts on the same assumptions, the system becomes fragile. If everyone's hedging risk using the same formula, then a small deviation, an unexpected twist, can create feedback loops. Prices shift, assumptions crumble, risk explodes. This is the illusion of risk management, that by modeling risk, you've neutralized it. But in truth, you've only transformed it, made it quieter, less visible, until it's not. Take a moment, reflect. The Black-Scholes equation is not evil, it's brilliant. It opened doors, sparked innovation, reshaped finance. But its legacy is not just in what it solved, but in what it ignored. And perhaps, in what it taught us about ourselves, that we would rather believe in a beautiful lie than face a messy truth. That when handed a tool that promises certainty, we stop questioning the foundation. That math can comfort us, even when it misleads. In the end, Black-Scholes is more than a model, it's a mirror. It reflects our deep desire to quantify the unquantifiable, to put numbers on chaos, to turn probability into destiny. But risk isn't something you erase with an equation, it's something you live with, something you respect, something that waits in the tail of the curve, just out of view. Behind the public face of the market, the charts, the earnings reports, the carefully worded press releases, there exists another layer, a quieter one. Hidden from the crowd, it's the domain of insider information. Whispers before announcements, forecasts before the press gets wind, a nod, a memo, a well-timed sell order moments before the storm. Insider trading is illegal in most financial systems, but the temptation of secret knowledge of information asymmetry has always been hard to resist. Why? Because in a system built on timing and trust, knowing something before others do is more powerful than money itself. It's the kind of power that doesn't just predict outcomes, it shapes them. But here's where things take a strange turn. Because insider trading isn't always about information in the traditional sense. Sometimes, it's about structure, about understanding the mathematical scaffolding of the financial system so well that it creates what appears to be prophecy. This is what some call insider math. Imagine knowing how certain funds rebalance their portfolios on the last day of every quarter. If you anticipate those moves, if you know the rules of their models, you can trade just before they do and profit off the predictable price shift. It's legal, it's strategic, it's structural advantage, and yet, it feels like cheating. These are not random guesses. These are calculated manipulations of systemic inertia. You're not breaking the rules. You're just understanding them better than most. And understanding creates leverage. This kind of insider math often requires no secret memo, no breach of ethics, just a level of access to data, to modeling, to algorithmic behavior that most people will never touch. It's like having a map of the maze, while everyone else stumbles in the dark. One of the most famous examples, order flow information. Some high-frequency trading firms pay brokers for access to order flow data on what retail traders are doing. It's anonymized, yes, but still incredibly revealing. With this information, they can front-run trades, not in the illegal sense but in the technical sense. They can see patterns forming milliseconds before they happen, and move in first. Imagine this, 1,000 people are about to buy a stock. The system knows, the algorithm reacts, it buys first, the price goes up, it sells, and it profits. No secrets were leaked, no laws were broken. But the game was not fair. This is the essence of mathematical edge. It's less about knowing a fact, and more about knowing a system so deeply that you can see through time. And yet, very few talk about this, because to acknowledge the role of insider math is to admit that markets are not as meritocratic as we like to believe. We tell ourselves that with enough study, enough grit, anyone can make it. But some are not just playing the game, they're programming it. They don't analyze the market. They engineer its response. This isn't a new phenomenon. In the early 1990s, hedge fund manager Jim Simons built Renaissance Technologies, a fund driven entirely by mathematical models. It outperformed the market by such a margin, year after year, that many believed it must be magic. But it wasn't magic, it was math. It was petabytes of data, statistical models that saw relationships no human analyst could. It was secrecy and precision and structure. And perhaps most disturbingly, it still works. That kind of success reshapes the philosophical question, What does it mean to beat the market? If the market is something you built to be beaten, where is the line between skill and structural privilege? And how many people are profiting not because they see the future, but because they wrote the code that defines it? Take a moment here, let it settle. Because what we're talking about isn't just finance, it's the idea that truth can be engineered. That with enough data, the system can be cracked, not through intuition, but through models that feel more like physics than economics. And here's where it turns even darker. If insider math exists, and is legal, and is profitable, why would those who hold it ever want to change the system? The deeper their understanding, the harder it becomes for outsiders to catch up. The gap widens, power concentrates, wealth compounds. The game becomes self-reinforcing. The players who know the system best can afford to protect it, influence it, even rewrite its rules when necessary. And so in the quiet halls of quantitative research firms and proprietary trading desks, the code of the financial machine continues to evolve, faster, deeper, more abstract. Meanwhile, the rest of us interpret graphs, listen to pundits, try to make sense of it all. But the truth is, we're not playing the same game. Picture two strangers. They're both arrested, separated into rooms. Each is given a choice: stay silent or betray the other. If they both stay silent, they serve a short sentence. If one betrays and the other stays silent, the betrayer walks free while the silent one takes the fall. If both betray, they both serve long terms. They can't talk to each other. They must decide alone. This is the prisoner's dilemma, one of the most famous problems in game theory, a field of mathematics that studies strategy, cooperation, and competition. At its core, game theory explores what happens when multiple players make decisions that affect one another, when trust is fragile, and betrayal is tempting. But what does this have to do with money? Everything. Because markets aren't just machines, they're games. And everyone is playing. Investors, governments, corporations, central banks, consumers. Each actor making moves, watching others, second-guessing, bluffing, and responding. Game theory reveals that even in rational systems, optimal outcomes often depend on trust, a fragile and easily broken thread. Let's say two companies are locked in price competition. If both keep prices high, they make good profits. If one drops its prices to steal customers, it wins, temporarily. But if both undercut each other, profits collapse. This isn't a hypothetical. It happens constantly, in retail, in airlines, in oil production. Each player is trapped in a game, to betray or to cooperate. And the logic of game theory shows us that without enforced cooperation, betrayal becomes the dominant strategy. That's why cartels exist. That's why price fixing happens. That's why regulators are always watching. Because game theory, left unchecked, leads to outcomes that benefit no one. But it gets deeper. Consider market bubbles. As asset prices rise, more people rush in. Not because they believe in the fundamentals, but because they believe others will buy in after them. The game becomes one of greater fools. How long can you hold before someone buys at a higher price? It's not about value. It's about timing. Everyone knows the bubble will burst, but no one knows when. So they keep playing, hoping they won't be the last one holding the bag. In this game, rational behavior becomes irrational in the long term. And this is where the paradox emerges. Markets reward short-term gain, even when long-term collapse is inevitable. You may not intend to crash the system, but if everyone plays selfishly, the system crashes anyway. We see this in environmental markets too. The classic tragedy of the commons, where shared resources like air, water, or fish stocks are overused, not because anyone wants collapse, but because no one wants to be the only one who sacrifices. Why should I reduce emissions if my competitor won't? Why should I report honest earnings if my rival inflates theirs? Why should I save during the boom if everyone else is spending? Game theory explains how strategic incentives often drive us away from collective well-being, even when we all agree on what good looks like. But it also offers glimpses of hope, because under the right conditions, when players communicate, repeat interactions, build trust, cooperation becomes stable. In iterated games, where the same players interact over time, mutual benefit often emerges. Strategies like tit for tat, which reward cooperation and punish betrayal, create long-term balance. This mirrors real-world financial relationships. Banks lend to those with good histories. Investors reward consistent companies. Trust compounds over time, just like interest. But the moment uncertainty returns, when players change, incentives shift, or information becomes hidden, trust breaks. We saw this in 2008. Mortgage-backed securities became too complex. Risks were buried. Everyone assumed someone else had done the due diligence. When the truth emerged, trust collapsed. Liquidity froze. The game stopped. Because game theory isn't just about choices, it's about information. Who knows what, when, and how do they act on that knowledge? This is why asymmetric information, when one party knows more than the other, is so dangerous in financial systems. It leads to moral hazard, adverse selection, predatory behavior. It creates environments where players are incentivized not to win together, but to win alone. Now pause, breathe, let the implications settle in. Markets aren't free-floating. They're ecosystems of decisions, systems of strategy, interlocking games of trust and deception, patience and panic. And in that complexity, something deeply human emerges. Because every game is a mirror of our values, our fears, our logic, our shortcuts. Game theory shows us not how to beat the market, but how fragile the balance is between cooperation and collapse, how easily a rational actor can become an accidental villain, and how often the smartest move is the one that helps everyone win. But of course not everyone plays by those rules. Close your eyes for a moment, and imagine a marketplace. Not a digital one. A real physical market. People walking, talking, exchanging goods, feeling the energy around them. Now remove the sound. Slow everything down. What do you notice? Behind every transaction, behind every price, every decision, there's something deeper than logic. Emotion. Markets are often described as rational, mathematical, governed by invisible forces, supply and demand, interest rates, policy shifts. But beneath that is something far more unpredictable, far more primal: fear and greed. These two forces, ancient, simple, and human, have shaped financial systems since the first coins were ever exchanged. They make bubbles, they burst them, they drive booms, they trigger crashes. And no matter how much math we wrap around our models, no matter how precise the code, fear and greed still lurk underneath. Why? Because money is never just about value, it's about meaning. It represents survival, power, freedom, status. And when something symbolizes all that, emotions come flooding in. Greed whispers when prices rise. It says, buy more, don't miss out. Everyone's getting rich. It inflates expectations. It fuels speculation. It creates the illusion that this time is different, that the curve will never go down again. We saw it in the tulip mania of the 1600s. We saw it in the dot-com boom of the 90s. We saw it with crypto in 2021. We will see it again, because greed is eternal. But then, the winds change. A whisper becomes a rumor. A headline sparks doubt. And suddenly, fear arrives. Fear doesn't walk in quietly. It panics. It sells. It runs for the exits. Prices crash. Confidence evaporates. The same crowd that rushed in yesterday now rushes out today. This is what behavioral economists call loss aversion. The idea that we feel losses more intensely than we feel gains. A 10% drop hurts more than a 10% rise excites. And this psychological asymmetry shapes everything in finance. It causes overcorrections. It causes irrational risk aversion. It causes market spirals, where selling triggers more selling. Not because anything truly changed, but because fear is contagious. What's strange is how predictable it is, and yet how unstoppable. We know these patterns. We've studied them. We've named them bubbles, corrections, flash crashes, but we still fall for them. Why? Because we're not just economic agents, we're emotional beings. Even when we build systems to reduce emotion, algorithms, bots, data-driven trading platforms, those systems still mirror the people who made them. An AI doesn't feel fear, but if it's trained on market data created by humans, it learns the patterns of panic. It trades accordingly. In this way, emotion becomes encoded into the system itself. You might call this the emotional fingerprint of the market. Even in silence, it's there. It's in the sudden volatility after a political event. It's in the sell-off after a vague economic forecast. It's in the breath people hold when the Fed speaks. Not because the words are always drastic, but because the mood is. The market, it turns out, is a mood ring. A collective subconscious, a pulsating reflection of our collective emotional state, captured in graphs and candlesticks. And yet, we pretend it's rational. We build elaborate models, we study charts, we use phrases like efficient market hypothesis and rational actor theory, but none of that can fully explain why people buy at the top and sell at the bottom. None of it explains why a single tweet can wipe billions off a company's value. Emotion is the ghost in the machine. Even central banks, the stewards of monetary policy, understand this. That's why they don't just set interest rates. They manage expectations, tone, posture, phrasing, all calibrated to soothe or stimulate. The economy isn't just numbers, it's narrative. Now breathe. Because this realization opens a deeper question. If markets are driven not only by math, but by feeling, what does that mean for control? Can something so inherently human ever be fully managed by formulas? Can we ever create a perfectly rational system, if irrationality is the most human thing of all? This question haunts economists, traders, and philosophers alike, because it points to a tension that underlies the entire structure of finance, that we want certainty, but live in uncertainty, that we crave growth, but fear loss, that we trust in systems, built by people who don't always trust themselves. And perhaps, that's the most mind-bending truth of all, that beneath every stock chart, every interest rate, every dollar in your pocket, is a heartbeat. There was a time when trading meant people shouting in crowded pits, waving papers, making eye contact, feeling the pulse of the market with their bodies. Now most of that has vanished. Today, a significant portion of global financial trading happens in fractions of a second, far faster than any human can perceive. It's not intuition. It's not emotion. It's not human at all. It's algorithms. Machines that trade at lightning speed. Systems that detect tiny inefficiencies and exploit them before a person can blink. They don't sleep. They don't hesitate. And they never second guess. This is the world of high-frequency trading, or HFT. To understand how it works is to understand how speed itself has become a form of power. Imagine a network of computers placed as physically close to stock exchange servers as possible, not because they need better access, but because shaving off even microseconds, a millionth of a second, can mean the difference between a profit and a loss. This is called co-location, and firms pay millions just for the privilege. Why? Because in this game, knowledge that arrives even slightly faster can be weaponized. An HFT algorithm might detect that a large order is about to be placed on the market. It reacts instantly, buying up that stock first, causing the price to rise, then sells it back milliseconds later at a slightly higher price, pocketing the difference. No value was added, no investment was made, no real risk was taken, just pure calculated extraction. To you or me, the price never even changed. But to the machine, there were dozens of tiny opportunities. It lived entire lives of profit in the space between our thoughts. Let that sink in. These systems don't care about the companies they're trading. They don't analyze value, or strategy, or vision. Their only concern is velocity, speed, and timing. The stock market becomes not a marketplace, but a battlefield of latency. Who can see the data first? Who can respond the fastest? And who can build the machine that can do both better than anyone else? There's something deeply unsettling about this, because while we often think of the economy as a human system, driven by choices, policies, ideas, it is increasingly governed by automated intelligence acting at inhuman speeds. And these algorithms don't just respond to markets, they shape them. They create feedback loops, mini flash crashes, cascading effects where one algorithm triggers another, and then another, until billions vanish in moments before humans even know what's happened. This has happened before. On May 6, 2010, the Dow Jones Industrial Average suddenly plummeted nearly 1,000 points in a matter of minutes, only to rebound just as quickly. Billions of dollars evaporated and reappeared. The cause? A complex tangle of automated systems reacting to each other in ways no one fully understood. It was later named the flash crash. And what's most disturbing, we still don't entirely know how it happened. We built machines to outthink us, outpace us, and they did. But now they're making decisions we can no longer trace. They operate in a realm we can't even observe in real time. It's like watching a chess game between invisible grandmasters who finish before you've noticed the first move. And the stakes aren't trophies. They're your pension, your mortgage, your government bonds, your national currency. Now breathe for a moment, because this isn't just about finance. It's a philosophy of automation, of what happens when we give up control, not just of processes but of meaning itself. In high-frequency trading, success isn't measured by creating value. It's about exploiting friction. It's about finding where human systems lag behind, and inserting machine logic into that space. It's not evil. It's not even malicious. It's just optimized. But in optimizing for profit, it may be sacrificing something else: understanding. When trades are happening faster than human comprehension, when systems are adjusting themselves through deep learning, self-correction and opaque logic, the question becomes, who's in control? If a machine crashes the market, and no human notices in time, is it still a market? If your savings are impacted by a decision made in microseconds by a line of code no one can read anymore, what does trust even mean? And here's where we spiral into deeper thought. Because this isn't just about speed, it's about delegation. What else are we handing over to algorithms? We already have machines writing news, machines curating our feeds, machines recommending what we watch, what we buy, what we believe. Finance is just the most visible, most volatile tip of the iceberg. High-frequency trading is a glimpse into a future where intelligence is outsourced, not to people, not even to institutions but to systems we no longer understand. A world where decisions are made, not with reflection or morality but with pure optimization. Cold, logical, instantaneous. It raises the ultimate existential question. If machines can outperform us at thinking, deciding and earning, where does that leave us? What is our role in a game we can no longer follow? As we drift through this thought, the pace of the world seems to dissolve into code, into circuits, into untouchable logic. And yet, beneath it all, there's something more ancient than algorithms: emotion. Because even in these highly rational systems, something irrational still moves the markets: fear, greed, hope, trust. It's the silent engine behind every dollar, every transaction, every economy. But what happens when we no longer trust the people who create the money? In 2008, while banks collapsed and governments scrambled to plug the leaks, a strange document appeared on the internet. Just 9 pages long, published under a pseudonym, Satoshi Nakamoto. Its title, Bitcoin, a peer-to-peer electronic cash system. It offered a new idea, a radical one. What if we could have money without banks? What if trust didn't need to be placed in people, but in math? At the heart of Bitcoin, and every cryptocurrency since, is a concept called the blockchain, a decentralized ledger, a digital history book, not held by any one institution, but duplicated across thousands of computers around the world. Each transaction is verified not by a central authority, but by consensus. No kings, no gatekeepers, just code. This wasn't just about digital money, it was about digital belief. Cryptocurrency invites a world where trust is not enforced, but emerged, where value isn't printed, but mined, through algorithms, through proof, through energy. It sounds abstract, but at its core, it's beautifully simple. A system where no one needs to be trusted, because no one can lie. In theory. And like all things we worship, crypto became more than a system. It became a movement, a rebellion against central banks, against inflation, against the unseen hands of monetary policy. People didn't just invest in coins, they invested in a story, one where power was pulled from the few and given to the many. Decentralization became the mantra. Freedom through encryption, sovereignty through wallets, autonomy through anonymity. But here's where it gets strange. While Bitcoin was meant to escape the money game, it quickly became a new version of it. Volatile, speculative, wildly profitable for the early few, and increasingly controlled by a different elite, not governments, but whales, mining farms, and digital influencers. Crypto promised decentralization, but networks still consolidate, power still accumulates, and the belief, once anti-establishment, became its own cult of confidence. Prices rose not because of utility, but because of faith. Not in central banks this time, but in algorithms, in memes, in the idea that others would believe what you believe, just long enough for you to sell. And so a new paradox emerged. Crypto, born from distrust, became a system built on a new kind of trust, not in institutions, not in paper, but in code, and in the unspoken hope that code can't lie. But code is written by people. Smart contracts are only as smart as their creators. Blockchains are only as fair as their protocols. And if something goes wrong, if a bug lets millions disappear, there's no central authority to fix it. That's the price of trustless systems. You own your keys, you own your losses. Pause here, because crypto doesn't just change how money works, it changes what we expect money to be. Traditional money decays over time. Inflation eats its value. Crypto can be programmed to deflate, to grow scarcer the more people use it. This creates a strange inversion, money that becomes more valuable, not through work or policy, but through waiting. A digital gold with none of the weight. That's both seductive and dangerous. Because if money is no longer spent, but held, what happens to economies built on exchange? What happens when value becomes something you sit on, rather than circulate? We already see the symptoms. HODling, pump and dump schemes, token-based microeconomies, where speculation replaces utility. The dream of decentralization warps into a casino, and yet, the core idea remains hauntingly beautiful. A world where money flows without permission, where the ledger can't be edited, where no ruler can print more supply in the dead of night, where identity is hidden, but trust is encoded. Is it perfect? No, but it's possible. Crypto doesn't replace the money game. It reprograms it. It replaces the central authority with distributed logic, replaces fiat with function, and it exposes something we often forget, that trust is a technology, not a given. Governments didn't always issue currency. Banks didn't always exist. Our current system is not eternal. It's just one iteration in a long, strange experiment. Crypto is a reminder of that. It shows us that money is not just a medium of exchange, but a container of values, both ethical and mathematical, and that we can, if we dare, rewrite those values. But as with all revolutions, we must ask who benefits, who builds the protocol, who audits the chain, who gets left behind when code becomes law. Because if we don't ask those questions, we're not escaping the system, we're just replacing one black box with another. So take a breath here. Let the thought settle, that the most powerful shift in finance might not come from economists or central bankers, but from anonymous programmers, armed with nothing but logic and a dream of trustless truth. Next we descend even deeper. What happens when algorithms not only store our money, but begin to control it? We step into the realm of high-frequency trading, where machines act faster than thought, and where milliseconds can mean millions. In the dim light of the financial world, some instruments don't represent anything real. They don't point to houses, cash, or even companies. Instead, they bet on the possibility of things. These instruments are called derivatives. They are contracts built on the price movement of other things, stocks, commodities, currencies, even weather, but they don't require you to own any of those things. You just need to believe, or fear, that something might happen. A derivative is a shadow of value, and in this shadow lies one of the most complex, powerful, and misunderstood forces in the money game. Let's walk through it. Imagine two farmers. One grows wheat, the other buys wheat to make bread. They both worry about the price. The seller wants to lock in a high price now. The buyer wants to lock in a low one. So they make a deal today about what the price will be in 6 months. That deal, just a bet, really, is a derivative. Neither of them knows what will happen. They're just trying to control uncertainty. But now, imagine a third person steps in. This person doesn't grow wheat, doesn't bake bread. They just bet on which direction the price will go. And if they guess right, they win big. Guess wrong? They lose everything. This person is a speculator, and there are millions of them. They don't want wheat, they want volatility. They thrive on uncertainty, because the unknown creates opportunity. The more chaotic the market, the more profitable the guess. And here's the twist. Speculators aren't rare. They're the majority. Most derivative trades aren't made to hedge or protect. They're made to gamble, at an industrial scale. We're talking about a market worth hundreds of trillions of dollars. Some estimates even place the global derivatives market in the quadrillions. That's more than the value of everything else on Earth, combined. And yet, these contracts are based on nothing tangible, just movement, just uncertainty. Let that settle. The biggest financial force in the world is not about producing, consuming, or owning anything. It's about betting on what might happen. Now pause here. Ask yourself, how do you build stability on top of uncertainty? The answer is, you can't. Not really. You can only build layers of risk management, which, in a way, are just more derivatives. It becomes a tower of bets, hedged by other bets, protected by further bets, all feeding off the motion of the layer below. A recursive spiral of abstraction, and eventually, no one's quite sure what the base even is anymore. This happened in 2008. The subprime mortgage crisis wasn't just about bad loans. It was about derivatives of bad loans, then derivatives of those derivatives, sliced, repackaged, renamed, traded like assets, insured against collapse, until the entire market became a house of mirrors, reflecting confidence that didn't exist. And when the illusion broke, the entire system trembled. Why? Because derivatives don't just live in the financial world. They shape it. They don't sit quietly on top. They exert pressure downward. The tail doesn't just wag the dog. It often steers it off the cliff. This is where things turn philosophical. Derivatives challenge the very idea of value by detaching it from substance. It's like making a map of a territory that no one's ever seen, and then trading the map as if it were the territory. This is not unique to finance. It mirrors our relationship to information itself. News is valued before events occur. Social media moves markets before reality does. Memes trigger economic reactions that analysts can't predict. We're not just reacting to reality anymore. We're reacting to reactions. Derivatives are the financial embodiment of this recursive loop. They are value systems one layer removed from the real, and sometimes 2 or 3 or 10 layers deep. And the deeper you go, the more unstable the structure becomes. Yet the appeal remains undeniable, because derivatives promise power. They allow investors to control large amounts of potential with relatively little actual capital. This is called leverage, and it's both seductive and dangerous. With the right derivative contract, you can turn $10,000 into a position worth $1 million. If you're right, you're rich. If you're wrong, you owe more than you had. It's a financial form of Russian roulette, but it doesn't feel like it, because derivatives are abstract, clean, digital. There's no blood on the page, no physical product changing hands, just numbers shifting on screens. And maybe that's what makes them so eerie. They invite us to believe in a world where money makes more money, without ever touching the real. A world where the unknown is more profitable than the known. Where uncertainty isn't feared, it's manufactured. Because the more uncertain the world becomes, the more derivatives thrive. Let that linger. Think of the broader implication that a significant portion of our global economy depends not on truth or value, but on volatility, on the very unpredictability we're taught to avoid. And that behind every crisis, every war, every policy shift, someone somewhere is profiting, not from what happens, but from what might. As we drift from this realization, the path ahead grows even darker. What if the money itself, the very fabric of value we trade, could be created not by governments but by code? What if belief in a central bank was replaced by belief in a blockchain? What is money? A piece of paper, a line of code, a metal coin stamped with a symbol. We use it, we chase it, we save it, we fear losing it. But we rarely stop to ask what gives money its value. Not its price, not its denomination, its meaning. Most of us assume value is something built in, that $1 is worth $1, because of some deep, unchanging truth behind it. Economists call this intrinsic value, the idea that something is valuable on its own, no matter who's looking. Gold is a common example. It's shiny, rare, durable, difficult to fake. For centuries, civilizations agreed. Gold had intrinsic value. But here's the problem. Gold can't feed you. It can't shelter you. It can't cure a wound. Its worth is assigned, not inherent. If no one cared about it, it would just be a shiny rock. So even gold, our timeless symbol of wealth, is only as valuable as our shared belief allows. The same goes for paper money, or Bitcoin, or real estate, or diamonds. These things don't hold value like a cup holds water. They reflect it, like mirrors, catching the light of mass belief, strip away that belief, and the value vanishes. Let's test this. Imagine waking up in a world where no one believed in the US dollar anymore. You walk into a store, try to buy food, and the cashier shrugs. We don't take those anymore. In an instant, the bills in your wallet become decoration. Beautiful maybe, but useless. That's how fragile value really is. It's not stored in the object, it's stored in the agreement. And this leads to a disturbing realization. Our entire global economy, the stock markets, central banks, real estate portfolios, digital currencies, all of it, rests on a kind of mass hallucination, a shared illusion. Not because it isn't real, but because it only becomes real when we all agree it is. Take a moment with that. We trade our time, our energy, even our health, for money. But money isn't the value, it's the placeholder, a symbol for value. And that symbol only works as long as we continue to believe in it, collectively, continuously, unquestioningly. This is the myth of intrinsic value, that things are worth something inherently. But the truth is value is not in the thing, it's in the mind. You can see this most clearly in markets. A painting sells for $100 million. A meme coin surges 800% overnight. A tiny parcel of digital land, inside a game, sells for more than a house. Why? Because someone believes it's worth that, and someone else believes they can sell it for even more. This is not madness. It's valuation. It's how speculation works. How bubbles form, how fortunes are made, and lost. And behind it all is this uncomfortable truth. Nothing has value unless we believe it does. That makes value fragile, but also manipulable. Governments manipulate value through inflation, interest rates, and monetary policy. Corporations manipulate value through branding, artificial scarcity and engineered demand. Influencers manipulate value through hype, perception and cultural capital. And we all participate in this system, whether we realize it or not. You might ask, if value is this fragile, how has the system not collapsed? The answer is both simple and eerie, because we need it not to collapse. It is belief held together by necessity, a collective faith ritual, and the more people depend on it, the more stable it becomes, not because it's true, but because the alternative is chaos. If that sounds religious, that's because it is. Money is a belief system, complete with rituals, buying, saving, investing. Myths' value is intrinsic, and sacred symbols, dollar, euro, yen, one of, even its high priests, economists, financiers, technocrats, all interpreting the will of markets like ancient oracles reading the stars. And like any belief system, it can be manipulated, weaponized, even lost. There are cultures, entire civilizations, that once used seashells as currency, stones, feathers. In those contexts, they were just as real, just as powerful as your credit card is now. But when the belief disappeared, so did the value. Value is not stable. It shifts with history, with context, with culture. And yet we build towering systems on top of it. Stock exchanges, mortgages, pension funds, cryptocurrencies. Each assuming that value is something we can measure objectively. But it's not. It's liquid, fluid, psychological. And in that fluidity lies both danger and potential. If value is imagined, then it can be reimagined. What if we valued time over productivity, community over consumption, wisdom over accumulation? The current system doesn't allow for that, not easily. It rewards extraction, speculation, hoarding, not because that's natural, but because that's how we've agreed to structure the illusion. But if we can agree to a different illusion, the system could change. For now though, we live in this one, where money flows not toward utility, but toward belief, where markets don't chase truth, they chase confidence, and where a single tweet can make, or erase billions in seconds. Let that float for a while. And as we drift forward, keep this thought close. We may think we're controlling value, but often it's controlling us, quietly shaping our choices, dictating our fears, setting the boundaries of what we think is possible. Next we descend deeper, past value, past money, into the systems that turn uncertainty into profit. We explore derivatives, the financial shadows of shadows, where even the illusion becomes a bet. Time is quiet. It doesn't scream. It doesn't demand. It doesn't negotiate. But but it compounds. And in finance, that quiet compounding becomes a tyrant. Not loud, not fast, but relentless, patient, inescapable. This is the hidden power of compound interest. A force so fundamental, so deceptively simple, that it can build empires or bury them, given enough time. Albert Einstein is often misquoted as saying, "Compound interest is the eighth wonder of the world." Whether he actually said it or not, doesn't matter. What matters is that he might have been right. Here's how it works. Imagine you invest $1,000 at a 10% annual return. After 1 year, you've made $100. That part's easy. But in year 2, you don't just earn 10% on your original $1,000. You earn it on $1,100. So you make $110, then $121, then $133, and on it goes. Each year the base gets bigger, the growth accelerates. At first, it feels slow, almost boring. But then, something strange happens. By year 20, your money has more than 6 times itself. By year 50, it's grown over 100 times. By year 100, it's not just money anymore, it's gravity. Now imagine that same logic applied not just to your savings, but to debt. A nation borrows money. A student takes out a loan. A hospital delays a payment. At first, it's manageable. But the longer it lingers, the heavier it grows. Debt begins to devour itself. Not through action, but through waiting. It's a trap made not of numbers, but of time. And yet this slow accumulation feels invisible. After all, we don't feel interest compounding. There's no sound, no shift, just a creeping transformation. And this is why it's dangerous. Because compound interest rewards those who already have, and punishes those who do not. If you begin life with assets, property, capital, investments, compounding is your silent ally. Your wealth grows quietly while you sleep. Your money works harder than you do. But if you begin life in debt, especially high-interest debt, then compounding becomes something else. A predator, one that stalks in months and strikes in decades. Consider this. The difference between earning 5% interest and paying 5% interest over 40 years is not small. It is everything. One path leads to exponential growth, the other to exponential decay. So much of inequality, economic, generational, even geopolitical, can be traced back to this single principle. And yet, it's never taught as deeply as it should be. Because there's something uncomfortable about a force, this powerful, hiding in plain sight. Take a breath here. Let it settle in, the idea that time, more than talent or effort, can be the strongest force in wealth accumulation, or wealth destruction. It raises a question. How much of financial success is really about decisions, and how much is just about starting position? In a game where compounding is king, the ones who start earliest or with more, almost always win. Even if they play worse, even if they stop playing altogether after a while, the math still works in their favor. It's not fair, but it is real. This is why billionaires talk about letting their money work for them. Because once your capital begins compounding, you don't need to do anything. In fact, the less you interfere, the more powerful the effect becomes. And there's something unsettling in that. Because it suggests that the very systems we're told reward hard work may in fact be structured to reward waiting. Or more accurately, structured to reward already having something to wait with. Compound interest becomes a quiet gatekeeper. And this isn't just about individuals. Nations too live and die by compounding. The interest on national debt, the compounding returns on sovereign wealth funds, even the time value calculations used by central banks when deciding whether to stimulate an economy or let it cool. All of it comes back to this one concept. Time magnifies advantage. Now think about this. Compound interest is deterministic, predictable. If left untouched, it follows a clear curve. And yet that predictability gives it power. In a chaotic world of markets, politics, and risk, it is one of the few certainties. So institutions use it, rely on it, weaponize it. Credit card companies use it to trap customers in never-ending debt spirals. Private equity firms use it to grow leveraged buyouts into billion-dollar holdings. Banks use it to make interest on interest on interest, sometimes lending money they don't even technically have, thanks to fractional reserve systems. It's not just a tool, it's a structure, a system of time-based control. And perhaps the most dangerous part is that it feels benign. There's no villain, no evil, just math. But the math is indifferent. It doesn't care who wins. It only cares who waits. Let that thought linger. What would the world look like if compound interest had never been discovered? Would wealth still accumulate into the hands of the few? Would debt still spiral for the many? Or is this just a natural result of exponential systems? Systems that quietly split the world, not into rich and poor, but into compounding and non-compounding. We leave this thought, not with a solution, but with a recognition that time is not neutral in finance. It is tilted, weighted, and those who understand it, those who harness it, build dynasties, not incomes. And now, we turn the lens from the passage of time to the illusion of value itself. Imagine a world where prices are perfect, where every stock, every asset, every trade reflects all known information, instantly. This is the world promised by the efficient market hypothesis, or EMH. It's a simple, seductive idea that markets are rational, self-correcting, and so efficient that it's impossible to beat them in the long run, because everything that can be known is already baked into the price. Every rumor, every headline, every spreadsheet, every forecast, it's all already there, quietly encoded into the number you see on the screen. In other words, if you believe in efficient markets, then there's no such thing as a cheap stock, no hidden gems, no undervalued opportunities, just a vast humming organism of pure equilibrium. But here's the paradox. If everyone believed that markets were perfectly efficient, no one would try to outsmart them. No one would analyze stocks, or study financial reports, or dig for secrets, because there'd be no point. Everything's already priced in, right? But if no one's looking for new information, how does the market stay efficient? It collapses under its own logic. This is the self-referential paradox of efficient markets. They only stay efficient because people believe they're not. The moment everyone trusts the model breaks. Let's slow down and let that sink in. A perfect market is only possible in a world of imperfect belief. And yet, many of our financial systems, pensions, mutual funds, even central banks, are built around the assumption that markets will usually correct themselves. That irrationality is a blip, not a baseline. But irrationality is not rare. It's baked into the system. Think of market bubbles. The tulip mania of the 1600s, the dot-com frenzy of the early 2000s, the housing collapse of 2008. These weren't anomalies. They were reminders, warnings that even the smartest people can get it wildly wrong when herd behavior and emotional speculation take over. And here's where math enters the shadows again. Despite decades of real-world collapses, the efficient market hypothesis is still taught in economics classrooms. It's still built into risk models. Why? Because it's elegant, mathematically neat. A universe where prices always tell the truth. But that's not our universe. Our universe is messy, emotional, prone to panic. So the math must ignore what it cannot control. It assumes away human behavior. It replaces uncertainty with probability curves. It writes over chaos with calculus. Let's take an example. Imagine a company, let's call it Brightco. Its stock trades at $100. A new report leaks, evidence of fraud. Investors panic. The price plummets to $40. But days later the company proves the report was fake. The stock climbs again. Was $100 the true price? Was it $40 or $70? At every point, the market believed it was right. And yet, the truth changed moment to moment, not because of new facts, but because of beliefs about facts. If belief determines price, and belief is unstable, then price is illusion. And still, we treat it as truth. This paradox echoes in our daily lives. We check the stock market for signals. We use it to measure economic health, personal success, even national power. But what we're really measuring is collective perception, a hallucination we all agree to believe. Take a breath here. Let that idea float, because this isn't just a problem for traders or economists. It touches everyone. If markets aren't rational, then neither are the systems built on top of them. Your retirement fund, your mortgage interest rate, the stability of your bank, all connected to the assumption that markets correct themselves. But if efficiency is a myth, then so is safety. What does that mean for control? Can we govern a system that's built on unpredictability? Or are we just passengers, comforted by models, distracted by numbers, on a machine that sometimes drives itself into a wall? There's a subtle unease in realizing that even our most trusted economic theories are built on paradoxes. But perhaps that's the point. Perhaps the real function of EMH wasn't to describe reality, but to give us something to believe in. A kind of economic mythology. Clean, orderly, reassuring, and maybe belief itself is the fuel. After all, if everyone believes the market is efficient, they behave as if it is. They trade less, they panic less, they trust the system, and in doing so, they help make it efficient. For a while, until it breaks again. Until reality leaks through the numbers and reminds us the map is not the territory. The model is not the truth, only a story. As you drift deeper into this thought, hold on to the tension, a market that only works when no one fully believes in it. A theory that must be doubted to survive. Next we'll shift from the myth of rational markets to a quieter tyrant, one that rules not through chaos but through time. Compound interest. The slow, patient mathematics of power. Have you ever wondered who or what really controls the flow of money in the world? Most people would say governments, billionaires, maybe central banks. But what if I told you that behind every trade, every loan, every collapse, there is math? Quiet, invisible math. Cold equations humming beneath the surface, deciding who gains and who loses, without ever asking permission. It's easy to think of the economy as a chaotic beast. But some of the world's most powerful institutions treat it as something else entirely, a machine. And like any machine, they believe it can be modeled, measured, and mastered through mathematics. Let me take you back to 1998. In the heart of Wall Street, a hedge fund called Long-Term Capital Management was quietly rewriting the rules of finance. It was backed by some of the smartest men on the planet, two of whom had won Nobel Prizes for developing mathematical models that could supposedly predict the future of markets. They believed in something called the Black-Scholes model, a powerful equation that could price complex financial instruments called derivatives. On paper, this formula was perfect. It reduced risk to numbers. It turned uncertainty into a curve. It told traders, with eerie precision, how much they stood to gain or lose on any given deal. And for a while, it worked, until it didn't. That year, the Russian financial crisis sent tremors through the global economy. Suddenly, the model stopped working. Assumptions failed. Reality refused to obey the math. And in just a few weeks, long-term capital management lost nearly $5 billion. The fund collapsed. The Federal Reserve had to intervene to prevent a total meltdown. What went wrong? At the heart of it all was a single illusion: that risk could be perfectly measured, that the future could be known, that math could tame the chaos of human behavior, geopolitical tension, and irrational panic. The Black-Scholes model is still used today. So are hundreds of others, algorithms, that sift through data at unimaginable speeds, making decisions in microseconds, faster than any human can blink. These models drive everything from credit scores, to stock trades, to mortgage approvals. We trust them. We depend on them, and most of the time, we never even see them. They're the shadow equations, quietly shaping our lives from behind the screen. Think about that. You might go to work, earn a paycheck, save your money, invest in a retirement fund, and yet every step of that journey is being nudged, pulled, influenced by formulas written decades ago, based on assumptions you've never agreed to. The interest rate on your loan, decided by a risk model. The performance of your pension, calculated using probabilistic forecasts. The price of bread at your grocery store, influenced by commodity futures traded using differential equations. Math isn't just behind the money game, it is the game. And yet, it's not perfect. Many of these models rely on something called a Gaussian distribution, also known as the bell curve. It assumes that most outcomes will cluster near the average, with extreme events being incredibly rare. But as history has shown us, repeatedly, financial crises, collapses, and bubbles are far more common than the math suggests. Why? Because people don't behave like numbers. Markets are not rational. They're emotional, tribal, panicked, greedy, fearful. When millions of individuals act in unpredictable ways, the neat curves of a model begin to tear at the edges. And that's the paradox. We use math to control a system that defies control. We build models to predict human behavior, only to be undone by the very irrationality that makes us human. But the math keeps running. Even when it's wrong, even when it's dangerous, it keeps pricing, calculating, recommending, optimizing. Because once you've handed the steering wheel to the algorithm, it's hard to take it back. There's something haunting in that. Imagine walking into a casino where the games are run not by dealers, but by machines. Mathematical black boxes that adjust the odds every time you blink. You think you're playing the game, but really, the game is playing you. Take a moment to reflect on this. Every financial product you've ever touched, your bank account, your student loans, your insurance premiums, your stock portfolio, was shaped by someone's equation. A formula written by a person you'll never meet, based on data you'll never see, using assumptions you'll never question. And that equation may not even be accurate. It may just be good enough to profit, until it isn't. So when we ask who controls the money game, the answer might not be a who at all. It might be a what. A formula, a string of symbols on a screen, a recursive loop in an algorithm, a model that no longer needs to be perfect, just profitable. Let that idea settle into your mind, quietly, gently. What if the world's wealth isn't driven by human decision, but by silent math? What if the biggest players in finance aren't strategists or visionaries, but machines blindly following code? And what if the future isn't something we choose, but something that's already been calculated? As you drift deeper into this thought, we move now to the next layer of the money game, where assumptions meet contradiction, where logic meets paradox.